hikes across several select food groups. Obviously, something we all talk about a lot, the price of eggs. Those are up about 59% from a year ago. The avian flu continues to wreak havoc on the egg industry. A dozen large grade A eggs on average cost about $5.90 in February, up from the average of $2.99 a year ago.
I'd love to pay $5.90 for a dozen eggs at this point. It's I haven't seen that price in months and months.
I don't want to rub it in, but in Italy, I'm paying less than that for my
Stop it. Stop it.
I'm sending them back home now.
And you're in Italy. Yeah.
It's all right. Other things cost a lot here, though. Then there's other breakfast staples, for example, where we're seeing upticks in prices, although not to the extent of eggs, like coffee, bacon, meat, especially beef. The price of ground beef increased 2.7%. Beef roast grew 2.8% in January. So the fast answer to that is yes, food prices have crept a bit higher. Now, looking at businesses like Walmart and Costco in this environment and beyond, I think these are two standout examples of really solid retail businesses within a sector and industry that is highly fragmented, and I think only has a few really great companies, in my personal opinion, that I would consider for an investment. Costco is one that I know even better than Walmart. But the thing that has stood out to me about that business is the way in which they have been so efficient with their supply chain, the way in which they will negotiate these prices with these long-standing trusted suppliers. They pass those savings down to the end consumer, and they're able to maintain these really razor-thin margins that, even though most of their product sales lead to their net sales, most of their profitability comes from those membership fees. And that has been a really consistent model through the years. Their membership renewal rates are well over 90% consistently.
You know, that's one thing I want to put a pin on that right now and talk about, because it's like, so they raised prices last year. They raised the membership fee for the first time in quite some time. And we're just starting to see quarters where basically every member that comes in has to renew at the higher price. Like it's starting to happen. And I was looking when they reported earnings a few weeks ago, that was one of the things I really wanted to see, is what happened with that renewal rate. And the interesting thing to me is in North America, the new renewal rate was actually up. It was a tiny bit, but I was expecting it to fall a little bit, which is normal. When you raise prices, you create that tension on the consumers on the edge case where you may push it to where it's no longer viable. And we didn't see that in the numbers, right? And that's the most impressive thing to me about this business, is that they demonstrated they have pricing power on that membership. They were able to raise it, and they're not providing a nickel more value. It's the same exact value that it was in 2024, but in 2025, they're able to earn that higher fee. That says that says more to me than anything you could say about the quality of the business.
Yeah, and it's interesting. Just to put some numbers to that, in terms of renewal rates, at the end of this most recent quarter, they reported their U.S. and Canada renewal rate was 93%. Their worldwide renewal rate came in at 90.5%. But again, most of their warehouses are located in North America. And, it's interesting. They ended that quarter with 78.4 million paid household members. That was up 7% year over year. So again, even with this uptick in prices, not only did you see growth on the top and bottom lines, but you saw growth in membership signups. They have also been doing a really good job of growing their executive membership base. They had 36.9 million paid executive members at the end of the quarter. That was a 9% uptick from a year ago. And those executive members now represent 47.1% of paid members and 73.8% of worldwide sales. So that is a very, very sticky model. And what was
the Q2 US Canada renewal rate?
93%.
It was 92.8 in the first quarter. And again, they raised the price and it ticked up a little bit.
A little tiny uptick there.
Yeah.
We'll take it.
Yeah. I was expecting it to fall to 90, 91. And that would have been super pleased with that. And it didn't.
It's because it's still an exceptional renewal rate, right?
It really is. Yeah.
With Walmart, the thing I'll say is with this business, again, they're known for their, low cost model where they pass their savings down to the consumer. They obviously have a different model than Costco. I mean, they do have Sam's Club, but they're not so reliant on membership fees the way that Costco is. I've said this on different shows. I think the response to their recent earnings call and the comments from management was an overreaction. I think that it was a situation, and this is my opinion, where the CEO and management set expectations. They're still saying we have momentum driven by our low prices. We've got a growing assortment. Our e-commerce business is thriving. That's been a really successful segment for them as they boost their omni-channel business. Their U.S. grocery business makes up 60% of total sales. And that saw a nice, healthy mid-single digit same-store sales growth. But that also tells you that 60% of total sales are non-discretionary. There's probably more than that, but that's just U.S. grocery alone makes up more than half of their business. And, even though discretionary items like toys, home decor, fashion have been lagging in recent years, those segments saw low single-digit growth in the quarter. You're still seeing that successive mid-single digit same-store sales growth driven by that grocery business. It is a dynamic backdrop, as management noted, but they even said, our outlook assumes a relatively stable macro environment. We acknowledge there's still uncertainties. They're looking to increase net sales between 3% and 4% this next year, which is just slightly below what they just reported. Quarterly revenue increased about 5.3% in the recent period. I think these are really interesting businesses to look at, not just because of their models, but because I think that so much of their business comes down to targeting what consumers need in a wide range of economic environments that does not change, regardless of what's happening with the macro landscape. And then if you're in an environment where, the consumer wallet is more constrained, there are more concerns about the state of the economy, having a place to go where you can access groceries and other items at much lower than average costs or in bulk, as in the case of Costco, that is a really strong value proposition to the end consumer.
Yeah, I think that's a couple of points on that. So with Costco, they've done a great job of building a business that, whether it's their business customers, everything they buy there is necessary for their business, right? The vast majority of the bulk of what they buy is for their business, and they're just consumer customers generally they have enough disposable income where, again, we've seen it from the new renewal rates don't lie, that the value proposition is clear. And these are largely discretionary consumers who go there for staples, but also have the flex in their discretionary spending, that the value is going to continue to be there, right? So I think that's important. We've seen Walmart move up the strata in terms of its target customer. Speaking of Target, I guarantee that Target has lost some customers to Walmart, customers that have had to move maybe downstream a little bit to save a little bit of money. We've also seen the dollar stores as a category broadly have really struggled, to the point that like Dollar General is now closing a bunch of stores and kind of reformatting some other stores because they haven't had the inventory mix to meet the needs of their customers. So I think a lot of those customers have also moved more to Walmart. And you mentioned that 60% of sales are in the grocery aisles. Walmart's just in the past few years finally figured out e-commerce. Yeah. They're just now figuring it out.
They were a little late to the game, but they're still doing a good job. Yeah.
Well, they're doing a good job now, right? That's the key. They've really figured out the model that's going to be compelling, and they're building on it. And that part of their business, I think, is really going to grow. And we're going to see that grocery share shrink because they're going to grow their share of the e-commerce pie. And that's going to be a profit driver for their business. I think that's a reality. But I just want to put some context. So, I mean, we're telling a love story about these businesses here. We got to talk about the stocks. If you can share the screen here. So, looking back over the past, this is going back to March of 2023. So we're looking at 2 years. These stocks are up almost 90 and over 80% respectively, even with the sell-off that we've seen that has brought both of them down. How much are they down from their highs? 16 to 19%. So they've sold off a lot more than the market. So there's lots of investors out there that are saying, hey, now's the time to buy. These are down a ton. The market's down 10. We're seeing the market bounce. I'm going to buy these while they're on sale. Here's the problem, guys. Costco's earnings are only up about 27% during that period. Walmart's are up about 73%. So what does that mean? That means for both of these businesses, we've seen a lot of expansion of the earnings multiple, right? Costco stock cost 50% more today. Walmart's is about 8% more today. So when you get to businesses of this size, the quality is super important. But Rachel stated the growth rates. The revenue growth rates are like low to mid single digits for these businesses. yes, they can turn that revenue growth rate into more earnings through operating leverage. They can grow revenue 5%. They can probably grow earnings 8 to 10%. But you're paying this kind of multiple for a business that in a best case scenario is growing its earnings 8 to 12%. That's a big premium. Be mindful of that is all I'm saying. This is not a like back up the truck kind of time for these businesses. I think they're super high quality. There's no getting around that. Just be mindful of what you're paying. 53 times earnings. It's better than 65, which is where Costco was, just a few weeks ago, but it's still 53 times earnings for a business that's growing its revenues, 5 to 7% a year in really, really, really good years. So just be mindful of that. That's all I wanted to say.
Yeah. There was a question I wanted to hit really quick. Let It Ride was asking, where do you rate legal actions on the news or noise scale? And Let It Ride gave a couple examples. Obviously, Alphabet Antitrust, Johnson & Johnson,
this question.
with their tout claims, and Novo Nordisk, which I went in depth into that recent legal filing earlier today. For me personally, I probably follow litigation more closely within the healthcare and pharmaceutical space, given that's an area of focus for me. These are things that I pay attention to, right? But they haven't really. I'm an owner of J&J. I don't currently own shares of Novo Nordisk. To give the example of a business like Johnson & Johnson, they have been involved in talc litigation for many years at this point. They've tried numerous times to consolidate some of these claims, settle some of these claims. They've also tried to consolidate some of them under the wing of a company that files for bankruptcy. There's been a lot of different actions they've taken to attempt to resolve these, some of which have been successful, others of which are ongoing. In the case of a company like Johnson & Johnson, they have billions and billions and billions of cash on their balance sheet at any given quarter. And even some of the highest settlement amounts that have been thrown out there as litigation has been ongoing would really represent just a fraction of their overall capital. So it really depends on the business. If you're looking at one of these big healthcare companies that has a ton of cash on hand, that has a large enterprise and leverage with which to, address these claims. And again, I'm just addressing this from an investment perspective, right? That is not something where I worry about their operational efficiency long term. Novo Nordisk, this is a newer claim. This is related to their Redefine 1 trial for their new next generation GLP-1 drug, where essentially they had previously hoped that the drug would achieve a 25% reduction in weight loss for patients who took it over a course of 68 weeks. In that Redefine 1 trial, the drug actually did meet its primary and co-primary endpoints. It achieved a weight loss reduction of roughly 23%, even though some previous numbers that have been floated around were as high as 25. But this most recent lawsuit filed against Novo Nordisk, it's a securities class action alleging that certain groups of investors were misled about the potential of this drug and as it relates to that particular clinical trial. It's something I'm watching. If I was currently a holder of this stock, as I mentioned earlier, I have been a longtime investor in Eli Lilly, and I have not taken a position in Novo Nordisk. If I was a holder of this stock, I wouldn't necessarily be adding to my shares right now, but I wouldn't be rushing to sell them either. This is, again, a company that has billions on their balance sheet. The industries in which at least these big healthcare pharmaceutical companies operate is highly litigious. Litigation is part of the course and cost of doing business. It is very much accounted for in the way these businesses run. So for that space particularly, that's generally my thought process there.
The legal actions very much across the continuum, depending on what they are. So if you're looking at Yahoo Finance and the ticker feed, and a company stock has gone up a lot on an acquisition announcement or fallen on bad earnings or something like that, the feed is going to get flooded with their advertisements from the law firm of Dewey, Cheatham and Howe. You get it? Dewey, Cheatham and Howe. That are, again, this is kind of crass, but it's the ambulance chaser of the finance world, where they're simply trying to build a class. They're trying to build a class action, and they're looking to try to build a class before they even have evidence of any wrongdoing, right? Every single time. It's based on the company reporting bad results and changing guidance or something like that. I shouldn't say every time, but more than 99% of the time, right? So those are noise. Those are absolute noise that I generally ignore, unless there's something clearly material that the company is putting out there, like they're having to restate 2 years of financials or something like that.
Yeah, that would be a big concern.
That is right. And the reality there is that the stock has probably already fallen, but it's very news, very like 7 or 8 or 9 on this. Like, I got to go do some work and research and figure out, maybe it's something that's pretty minor and it's going to be material, but it's going to be a very small thing. But it's very much on the what the heck is going on and why don't they know what's going on with their business sort of thing. So that makes it material. Now, moving into the bigger class action stuff, and I'll use 3M as an example with their hearing protection that they had a settlement because of hearing damage to U.S. military service members that had hearing damage because they had a faulty product. And then they've had other products too, where there were lawsuit PFAS, right? So I have zero respect for the management of that company, the way that they handled PFAS that's caused irreparable harm for a lot of people in public water systems with equipment that they were providing for that was introducing PFAS into the water supply. So those things are very much on the material end of things where I seriously consider them, and not as much just for those things, but what's going on with the business that culminated in this thing that's now happening, right? Because generally there's a signal there that there are other problems in that business. Its operations isn't good. The corporate culture's weakened. They're putting finances above R&D and innovation, right? Things like that I think moves very much more on the 7 or 8 area for thinking about this. That's a material thing that's telling me that maybe this isn't a business that's interesting for me to own. Sometimes the signal though is it's a turnaround opportunity. Trex is an example. The talked about them. It makes the composite decking to replace wood. Some of their products that they made around the financial crisis era, before the CEO came in, that basically turned around and saved the business, and turned Trex into this incredible company that it is. Their R&D had gone downhill, and their products were very problematic. They would mildew, and they would curl. Like, there were all kinds of problems with them, and there were multiple class action lawsuits. And that one was this was a big business that had been successful and created the industry, but had lost its way. And the signal there was, can their new management make this turnaround work? And then is there a growth potential from there? And that's a perfect example of a winner, where at the bottom, the business was a mess. And those lawsuits were evidence that the business was fundamentally broken in some ways. But fortunately, we got a great CEO that came in, saved the business, and now 3 CEOs later, we're still doing very, very, very well there.
I think the bottom line is it is really a case by case thing, and obviously sometimes you might see some of these bigger, wider scale litigation actions, and that could impact your own personal thesis regarding the company based on the types of companies and corporate values that you're interested in investing in, and that's a very personal journey. I think very much looking at these things, it's important to pay attention when there's big cases that are filed involving companies we own or follow, but how that actually translates to a material impact on the investment is incredibly variant. I gave an example with healthcare businesses, Jason talking about, 3M, which I think is also a good example of one where it is a material impact. So it does truly depend. And I think that's, again, something to factor into one's risk analysis.
All right, we are up against it. It is 1:00, and
the hour flew by.
For what I like to call the AA power hour here with Asit and
yes,
love good, it. Right? That's good.
Yeah, it's growing on me.
You guys can keep it. You guys can keep
Thank
it.
you.
Is it like the mildew that was growing on Trex back in the early 2000s?
Wow. Yeah.
Or is it like a really great 70s mustache? Which of those is it? Growing on you.
Great 70s mustache.
70s mustache.
Love it. Okay. All right. My work here is done. Fools, I'll see you soon.
Guys. See you soon.
Good to see you guys. Hello, Asit.
Hey, Andy. How are you?
I'm doing fine. I'm coming
Good.
from Alexandria. I came into the office
see.
today, so I brought
Nice.
some of my equipment down. So hopefully this all goes smoothly and we can have a good hour. So I'm glad to be here. Glad to see the markets recovering a little bit, which is
Always
nice after a very tumultuous week. So a lot to cover. And we're Asit Sharma. Well, he's Asit Sharma. I'm Andy Cross. We're on Team Stock Advisor, among other things, and we're here to talk stocks for the next hour. Thank you for joining us on Fool24. If you're here as a member, you can join us, and please hit slide. Go over to slido.com. The code is Fool24. Put in some questions, and if you're enjoying us on YouTube, thank you very much for stepping in and viewing us. And if you're hopefully you can find some value. If you're interested, come join us here at the Motley Fool as a member. Austin, anything particularly you want to kick off with, or just jump right into the questions?
Yeah. So just in general, Andy, it's funny when you were saying it's nice to see the market up a little bit today. I said it's always a pleasure. I meant to say it's always a relief after the market has had several down days. And psychologically, we sort of need that as investors. But it also always throws into relief for me, like, why am I so relieved when I see the market going up? I have a lot of faith in the businesses I invest in. I have a lot of faith in the ability of the global economy to create value. So theoretically, I shouldn't worry about a few down days. And we've all talked about uncertainty. We have a lot going on with the global economy, how the U.S. economy is trying to affect its relationship with trade partners. We don't have to rehash all that, but just to say that theoretically it's harder to suffer like the downdrafts than it's easier. Sorry, theoretically it's easier to suffer the downdrafts than when you're in the middle of it. And I just wanted to, as we start, just put a note out here for members who may be feeling like, wow, this has been hard the last couple of weeks. Yeah, I get that. I mean, same with me. I look at my portfolio, not a lot, but I'll check in with it occasionally. And we sort of get that the emotional element can never completely be detached from investing. In fact, it has its positive benefits. You should bring emotions in some sense to investing. It guides your rational decisions. That's where your gut comes in, the combination of sort of emotion and intellect. So just wanted to put that out there and get any thoughts before we do just dive into questions.
I think that's right. I think it's just thinking through how to handle the times that we go through. So I mean, we know, and as I've written, and Asit, you talked about, many times the markets go through these pullbacks in the market, dropping 10% about every 11, 12 months, 11, 12, 13 months, something like that. And we hadn't seen that maybe for, almost 2 years. And so now we're experiencing this. Obviously, a lot to think through in the markets. Government shutdowns. I see a question popped into slide about government shutdowns, market valuations, spending, consumer sentiment, a lot of those. And we've dealt with many of these situations before. It's always a little bit different, but it always rhymes, right? Asit, so it always rhymes. And I think what wins is really focusing on the next 3 to 5 years and trying to identify businesses and stay invested, because generally the markets do move higher. And even when they're moving lower over the short term, Asit, it's the ability to stay in the markets during those times and to look for those opportunities, because that's really when you can really earn some outsized returns over the next few years. And if you get scared out of the markets, it's very hard to come back in. So we really are here to try to encourage people to it's okay to make some tweaks on the margin, think about cash positions, maybe identify different businesses to own at different points, and building out those higher quality positions, but staying in the market as much as possible, I think, is really important.
Very true.
Let's get to some questions, Asit. What do you see out there? So, Let It Ride says, please rank the following for 5 years: MCore, TJX, Upstart. No, sorry, I'm not Upstart. Which is Unity Software, Instacart, CART, and BLD. Any thoughts to any of those, Asit?
Well, speaking of rhyming, this rhymes with a question. I don't know if it was from Let It Ride that I've seen before, which is combining, I think, EME, TJX, and at least CART. Maybe it was from another viewer, but these are interesting companies to compare in terms of what you want out of them for a 5-year hold. So just starting with TJX, Andy, this is TJX companies. They have the TJX, TJ Maxx stores and also home goods lines. So I think this is an interesting one in an economy where maybe some consumers are pulling back. On the surface of it, it might look like one that's vulnerable to a little bit of decrease in consumer discretionary spending. But on the other hand, we've admired the business for a long time, the ability of global TJX buyers to get discontinued inventory and just put that on the shelves at prices which draw people in for the treasure hunt aspects of those stores and also provide margin to the company. So that's a business in an economy like this that actually maybe counterintuitively looks a little attractive to me. So for 5 years from where we stand today, that's an interesting one. Why don't we do this and we'll just trade offs. Do you want to grab one and then I'll take another one, and we can rank when we're done.
Sure. Yeah. So, I think it's interesting. Asit, Top Build, BLD, it's about an $8 billion company, a relatively recent recommendation, does installation services and other building solutions along installations, their big business. They also have a services business tied to it and a distribution business. And the growth prospects have kind of slowed a little bit, but so is the multiple. And so when I look over long term, 3-5 years, I think the cycle is going to ebb and flow with that business. And right now we're in a little bit of a down cycle, right? We're not seeing the home building nearly as much. And they partner with home building as well as commercial side, but on the home building side for installation services, that's their bread and butter. And they've been doing this very well. And they're a leader in that field. But that market right now is just like Jason was saying earlier with Trex. It's just in a not great space right now, but I just don't think it's always going to be like that. So yes, could that stock fall further, 10% or so, or even, more, and as their earnings their growth rates, kind of stagnate a little bit. Yeah. But again, if you're taking that 3 to 5 year perspective, Asit, and you're saying, hey, I'm trying to buy and own businesses that I think over the next few years can grow earnings, invest smartly, and grow their share over time as the markets kind of recover, I think something like Top Build looks attractive and BLD looks attractive. And I think those are the opportunities that you can find when the operational growth metrics, the revenue, the earnings are kind of like, flatlining or maybe not quite as attractive. But that's over the next 12 months or so to be able to continue to jump out and look out 3 to 5 years, I think is much more attractive.
Yeah, Andy, I want to really just link to that one with the next one, which is maybe in a similar type of spot overall, which is EMCOR Group. So this is a company that is involved in commercial construction, and it has some specialties in industrial construction. So think about wherever you need complex electrical voltage within a commercial installation. They're great with that. They do this everything from like pure industrial companies to military bases. And they're also very forward in AI-centered construction. So where you've got complex needs for, let's say, a data center, you need a specialist to provide part of the electrical infrastructure. So EMCOR has opportunities there. This is about a $16.5 billion company. But in the same way, maybe from different factors than BLD, Andy, and I should give this symbol again. This is EME as a symbol, EMCOR Group. I think this also has hit a little bit of uncertainty because that market for data centers may be cooling just the slightest bit. And also we've got a lot of flux when we look out over the near-term economy. Uncertainty, it's not just about stocks. It also goes into businesses and the capital budgets for companies that may have construction projects on the books. So we see a company like EMCOR really compressing its multiples over the last year or so, even in the near term. So I just looked, as you were talking, it's trading now at around 17 times forward earnings, which is considerably down from sort of the recent average of its forward multiple. So here's another idea, which, if you believe that over 5 years, the economy is going to show some strength, that some of the demand that's out there for commercial construction is going to have, an outlet. Things will be built. If you believe that data centers, sure, maybe those most exciting estimates of how much can be built out in the next 5 years, maybe that's peeled back a little bit around the margins, but there's still going to be considerable investment in this area. Then a company like MCore Group starts to look interesting at where it's trading today versus, buying a company like BLD or EME when they're at the peak of their valuation. It's not that they're cyclical companies, Andy, but when you're associated with the construction industry, there are these periods where investors get a chance to buy these companies on a relative discount to where they've been trading in recent history.
Yeah, so I think that's right. Looking at a company like those two or like Instacart, it's thinking through, okay, the opportunity for Instacart is partially on advertising. Is that an option for Instacart to be able to take more share and grow their business as they think about expanding the market opportunity tied to their core business, which is really delivering and partnering with grocery stores? And I think those are interesting opportunities. So I don't think that would bubble to my ultimate top. I think probably something like BLD or maybe TJX would. But I do think Instacart has this, optionality that is also getting maybe not as appreciated because of the competitive nature, just with the nature of like the likes of DoorDash or Uber Eats when it comes to being able to serve their clients. And, Instacart has the experience working with the grocery stores, which is, pretty complex ordering, much different than just ordering, like a food delivery by itself.
Yeah, totally, Andy. And that brings us to, I think our last one is Unity in this group. Am I right? The question seems to have gone down the queue, but let me talk Unity for just a second. So Unity Software is a company that plays in sort of the gaming world and also the virtualization world. So it does sell products to businesses that are increasingly trying to use visualization instead of building things or before they go into a build cycle. So we look at industries like real estate, which lends itself to virtualization. Think of 3D tours of buildings. And then for this cycle of visualizing before, this is so funny, Andy. I've made so much fun of this one word. Over the last few years, there are a few like touchstone words I have when I'm at the dinner table with my wife. I'll always say them in an English accent. Visualization. In other words, another one is controversy. Now when I try to say them and it comes up in a business context, here we are, it trips me up. So I'll have to work on that and get it out of my system. My wife warned me about this years ago. She said, you're going to be saying these words and your audience isn't even going to know that you're joking and that you know how to pronounce them. Now, nonetheless, after that mini soapbox rant, let me complete the thought about Unity's software that's aimed at businesses. So if you are looking to maybe evolve in the robotics industry, you can use their software to really, instead of building and then trying to take feedback from the movement of the robots, you can use their software to save money, save cost on your visualization. So this is a very important aspect of Unity's business. The second that we talk about a lot, Andy, is just monetizing the ad business in the gaming industry. And this is where a lot of our turnaround thesis centered when we pulled it out of the penalty box in Stock Advisor. And the stock has done pretty nicely since then. It's starting to trade at what I think is more of a fair multiple in the near term. I think that Unity has much opportunity here in this space. It's up against very nice and robust competition from the likes of AppLovin, but that industry is big and it lends itself to growth. And I think that Unity's new management team, with a focus on monetization, bringing together a team that has experience in that ad space, in the digital programmatic space, has been good for the business. So I think the outlook is positive there. As for a 5-year hold from here, sure, I think that's an important one to look at for those who are trying to find companies that aren't at a peak valuation and still have some turnaround juice left in them. So from a 5-year perspective, I think Unity still makes a lot of sense.
I'll just note, I wasn't sure if I was still restricted from talking about MCore, but that's one I recently bought. And so I'm not restricted on it because the timeline has passed. So I think that's still attractive for the reasons that you mentioned, Asit. I took advantage to add to my original position at a lower cost basis. So I still think MCore, again, very much like Top Build, the data center explosion isn't always going to be there, but still, when you just think about the steady state and the need for those buildings and those services, I think it's really still attractive and very well run and a reasonable multiple. So that's one that I added to recently. Again.
Great. Here's one from Claire, which is, I've read recommendations to put cash in money market funds for better interest. Can you explain how that works? Do these have the same long, short holding rules for taxes? So Claire, two fronts. I think this question is a sort of a general personal finance question, but it's important to consider personal finance when you think about your stock investments. And maybe we don't spend enough time communicating that investing isn't just about the stocks you own, but it's about that larger goal. And it's about more assets than just the stocks you have. So if you have excess cash that you want to get a return on, a well-capitalized liquid money market fund from a reputable offer is not a bad idea, in my opinion. Bear in mind that many money market funds won't have the same FDIC protections as you would putting that money, say, in a covered CD or a checking or savings account. So you have to check. I know there are a fair number of them that are structured so that they're actually not falling within the FDIC protections. And sometimes the trade-off is you get a bit better interest. And I have, some, Andy, funds and money market funds myself. I think those are in a Schwab account. And
same.
And so they can give you a little bit of a better interest rate. Now, how does this work? It's cash. So it really doesn't have the same holding rules as stocks do for your taxes. Stocks are a capital asset. So they have a value. And when you purchase a stock, you have what's called a cost basis that's assigned to that stocks where you bought it. And then you have either a gain or a loss when you realize the equity or lack of equity in that stock. You make a sale. The difference is going to be either a capital gain or a capital loss. And that has a tax implication. Money market interest doesn't work that way. It simply works as ordinary interest income. And that, it just flows through your tax return. So in some ways, it's a simpler thing to follow. Just think of interest income, being taxed at the ordinary income tax rate. So a really much more simpler type of asset caches than stocks. But I think, it's good to think holistically and to put money to work, Andy, that you might not be investing in the stock market.
Yeah, 100%. I have money saved in high yield savings accounts or those just to have some money that's reserved, especially Asit capital that investors do not or will need in the next 3 years or so, maybe 5 years. We don't want that tied up in equities that can be very volatile over that time period. If you really need to tap into it, if you really need it. So make sure the money that you're investing in equities is really focused more on your long-term capital, not your near-term capital.
Such a tremendous point. Again, something that we should be talking about more. And I think we have in recent months and quarters.
Asit, one from a while ago that I wanted to just quickly hit was from Kevin Cochran about Snowflake, NICE, and the trade desk. And I just wanted to talk quickly about the trade desk on that one, Asit, because it obviously the stock is down, I think more than 50% from some of those highs as it is balanced between its exceptional performance as a public company on delivering on what they have said from a quarterly expectations, and then their first quarter really ever, or at least in years, on not delivering on their own expectations and some of the operational misses tied to their AI platform, Kokai, and some of their operational structures. Also, they just hired a new chief operating officer who I would say is not, as far as I can tell, not fully ingrained into the ad tech landscape. And the stock sold off pretty dramatically yesterday on a day when the market sold off in general. So I think there was some maybe a little uncertainty about going there on that front, but also as they are continuing to move more to a direct path optimization effort, where they are not always working with the ad clients, but they are working more with the publishers and the ultimate clients. That's a change from their core business model. So I think there's some shifts going through the trade desk. I think ultimately they're going to be okay and will win. And I have no problem owning the stock and buying more today. I've not added to my position recently, but I have no problem with that. I just think we have to, as Jeff Green kind of gets operational structure and they make this transition and learn from some of the operational mistakes with the Kokai transition on that platform, there might be a little bit further bumps and bruises, but I still think they are in a real sweet spot when it comes to programmatic advertising, delivering on both sides for the clients and the ad agencies, which they still have good relationships with, but also with the publishers. It's just that right now we're kind of going through this transition for the trade desk that we really have not seen in a long time. And they still are going to push on their superior technology, including their UID 2.0.
I agree, Andy. And this is something that is a storyline below the surface, which you bring up. And it's an important one to the trade desk, which is as the trade desk has always sort of, I think, driven the narrative about the company, it's been in terms of trade desk versus the walled gardens. But a story that's not as well understood is the fact that the trade desk has really been trying to work both sides of the equation to not be just a demand side platform, but to get business from the supply side through integrations, through broadening out its platform. To be not just a company that serves advertisers, but one that serves publishers, and not just advertisers as customers, but getting directly to the people who have the ad spends. And we've seen various expressions of this over time, just various terms that the trade desk has come up to discuss its partnerships with companies directly. But I will say they have sort of the same, and this is not bad in business, but I'll call it sort of a bloodthirsty bent towards going where they want to go, even if it means stepping on relationships that they already have. You operate as a demand side platform, and then partners that you work with on the supply side, you're going to enter that even as you need those relationships, and the same way with the advertisers. So I actually think this is beneficial for the trade desk over the long term. It would be better served being able to go straight to the purchasers if it can do that without endangering those critical advertising agency relationships in the near term. So there are so many threads to follow with this company. We all understand sort of the dynamics of Kokai. I know many fools have talked about it. I think our members also understand the dynamics of the connected TV market, how big that's becoming, and what an opportunity that is remaining for trade desk in front of it. But what you just brought up is something that's underappreciated. And I think that Jeff Green really understands where the company needs to go to keep its dominance in this field. And sometimes we see businesses just pulling back from challenging protected relationships and then losing total addressable market over the long term. And sometimes when you're big and want to sort of win against the competition, you've got to do this. You've got to make all your partners uncomfortable. So it's a really interesting insight that you mentioned about them. And just really, really briefly so we can keep moving. Yeah, just on Snowflake, I mean, I think they're making progress. Company is still, it's always had, even when it was down, Andy, it's very premium valuation. It continues to, but I think it's making some progress. And really the Snowflake's data structure plays very well in an AI future. The question is, can they execute? And the NICE systems, we've talked about this in Stock Advisor, and I think we've answered some questions on the reveal, but we're watching the new CEO who came over from SAP. And so far, so good, Andy. I think that's positive. My little concern with that space is, will agentic AI maybe cut into some of the business potential for companies that we admire like NICE?
Yeah, Scott Russell from SAP is really just getting his feet wet in the NICE business, but I think they depend on more demand from clients that are utilizing and implementing their software and expanding their relationship with NICE. And I think there's just some in that whole space. There's just some concerns. That's one reason why the valuation for NICE is very, very reasonable.
It's enticing in some ways, right?
Yes, much in reasonable. And I think it's still, the expectations are not very high, and they are continuing to invest. And if you look at the Gartner scores and the evaluation of their software, it is still leading, and they are integrating a lot of AI into their software packages, into their CX1 solution. But they need the demand there. They need the demand to be able to continue to, as companies are thinking about better ways to have contact center solutions for their clients in an expanded workforce, in a distributed workforce. I think they ultimately still do okay, but that there are challenges there with that Scott is facing. He's facing head on.
Quick question, or a quick answer to Matt's question on Disney over the last 5 years, or his comment: investors would have earned a higher return by placing their dollars under a mattress than they would have with the foundational stock. Disney referring to the foundational designation in Stock Advisor. And yeah, Matt, I know you've made this comment in various places and forums, and always appreciate the amount of questions that you bring to various places. And just to say, I accept that's a fair challenge. We're talking about Disney. Obviously, every quarter to us, it is still a turnaround story, and sometimes those take a bit of time to mature. I do see your point there, and I think it's worthy of the team to keep bringing this to the table when we talk about our foundational stocks every quarter. Okay, do we still really believe that Disney is going to turn around and start creating some value? So, this is a community, and this is a valid question when we think about foundational stocks. Okay, guys, is the future, you're saying the future will be good 5 years from today. Does that really hold with Disney? So I appreciate that. And we'll definitely consider that thought as we go along this year.
Oh, 1 second. I need to get to the...
Yep, sure. And sorry, the queue moves on us sometimes. So, and I can jump into another one while you're looking for the one you're going to answer. If you
just very quickly, Besties had talked about MCore. For me, it's MCore has the scale, the relationships. They're a big player in the space of electrical contractors, as Bessie said. There's lots out there, but I think they're trying to, their margin profile is improving. They still have the pretty healthy growth rates, both tied to data centers as well as other products, other construction products. So I think in that space, as you're finding companies that have pretty attractive valuations, very much like Top Build in the construction space, I just think MCore is just kind of, even though it's a large company, well run, still a little bit under the radar. And for me, it's not a large position, but I just wanted to kind of build it out, and my cost basis is right. It was a little bit down from where it is now, and I just wanted to kind of round out that position. And that's the way I was thinking about MCore. I'm trying to find out other stocks and companies that are not tied or as completely classified, Asit, as like growth companies or tech companies, and right. MCore kind of fit that bill.
Yeah, for sure. So there's a question here from Besties again. Nice to hear the history, but moving forward, what are your highest conviction stocks, and would you add to them now? Tell us your thinking about them. So I'd like to take this question, Andy, really from let's all learn to fish together. Rather than giving the fish. I don't presume to teach anyone, so I'll phrase it up that way. But I think it's a great question to ask, what is a high conviction stock? I mean, for me, what are my highest conviction stocks? If I roll them out in my head, is there something similar between them? And I think there is. And this is personal for everyone. For me, my highest conviction stocks are really my highest conviction businesses. And so that's always a constant. Now, valuation can play a role in what rises in conviction in a given month. We can get to that in a second. But for me, it's about being, in many cases, either dominant in the industry, like a number one or number two, or the potential over time to really be that dominant player. So either you're already established, or I can see the future where you become established. That's one. I think having a decent balance sheet to fund the growth, if it's a growth story, and to withstand adversity is important to me also. Excellent management teams are so important. If you study business, it doesn't necessarily have to be founder-led. We have a bias towards founder-led companies at the Motley Fool, and for good reason, because founders have in many cases, just a drive, Andy, to stick with the company through thick and thin. It's their baby, to make it succeed, to do everything it takes. And they all often have sort of a vested interest in stock that they have kept through the funding rounds when the company was private, and many of them still own appreciable percentages. What is appreciable to me? It could be like 4% and above. So that's important too. Product is important. Is the product getting pulled through the marketplace, or the service getting pulled through the marketplace, rather than a company having to push it with a lot of marketing spend? So all these things, and there's some others, but you get a sense of what I look for in a high conviction company. Execution. Has it executed over time? And then just, forward potential. If I look out today, can this company still be a winner? Those things tend to be factors that make a stock rise in my conviction. That execution part is pretty important. But Andy, I was curious, when you think about your high conviction stocks, like, what is it to you that separates the businesses and stocks you love most from all the rest?
There's a great question in there about adding to some of the great winners. So like a Shopify or a Mercado Libre, I think that's great. Taking advantage of those stock prices as they're falling, and it's really the falling mostly from the market, not necessarily from something like when the trade desk reported and they saw some of those operational challenges, Asit. So I think that's a great strategy if you're looking to kind of allocate more and more capital, depending on an allocation perspective, like adding to companies as you're building out allocations. I think that can be a wonderful, and I've done that, over the years with some companies from the likes of Chipotle to PayPal to Berkshire Hathaway, like those businesses, kind of adding to those positions. And I think that's one that is a really good strategy. I think for me, it's interesting balancing between the valuation. So something like Adobe, Adobe I think can be okay. I was saying this week. I think they do have some challenges in trying to really make sure their clients understand how their AI solutions are integrated with their solutions in a way that can deliver the tools they need at a reasonable cost that are better than what someone can find for free and to do it at scale. And I think Adobe is kind of wrestling with that, but it's still a business that generates very attractive margins, nice growth. It's probably I don't know, Asit, maybe like a 8 to 10% kind of top line grower, and maybe they can get some margin enhancement. They buy back loads of stock. And so I think when I look at that, I say, well, that can be a decent performer, but is the market telling me something right now that it's missing? And I see those opportunities in Adobe that the market's not seeing. And I don't know with Adobe if I necessarily see that. And I'm trying to identify those situations where the market's like, they're being a little bit too short term. And with Adobe, I don't know if I necessarily see it. I got to dig a little bit more into what they reported this week, but I'm still thinking that as of right now, the market has a little bit more right. Where with Trade Desk, I think the market got way ahead of itself at the end of last year. Now it's come back much more, and now the market may be a little bit too pessimistic.
Yeah, I think so. And it's hard in a day and age where so much relies on technology that we're just learning about. So in Adobe's case, to understand what its true advantages will be. I think the advantages are solid. And we've just take one moment to talk through this. Since I have you, I never get any time with Andy. That's actually a joke. I get a lot of time with Andy, and he's so accessible whenever I want. But I think it's such an interesting question, and maybe it's illustrative as well. A company like Adobe, it has very deep relationships with its enterprise customers, so they're not likely to just peel away because you've got some free, new, shiny AI tools out there. And Adobe, when you hear Adobe Creative Suite, that suite part is very important. It's a very broad solution, and it encompasses tools that have been proven over time. So really the question with a company like Adobe is, it looks attractive at this point. I think that maybe the market's fears of these other AI tools chipping away at market share are overblown? And that's sort of hard to determine right now. But I will tell you that in trying to learn about that, if let's say you out there who are watching are interested in Adobe, you own shares, just in learning about it, talking to an LLM, maybe ChatGPT or Claude or Gemini about this is really like instructive. You'll learn a lot about the company. You'll learn about the industry. You'll learn about the tools that are out there. So this is the fun part. If the complexity and hard part in this day and age is in some cases having to figure out what will happen with AI. Will this company be able to use it and fend off competition? Is it going to succumb to being disrupted? We all get smarter and we learn more about the company. So I, for one, am sort of interested in the Adobe story just from what I can learn out of this about the future, Andy.
Well, that's great. Curiosity is the most important, not the most important, but it's a very important factor to have as an analyst.
Okay, so Sean M has another personal finance question, and I know again, often we focus on the stock questions, but let me take a stab at this one. Sean says, and I'm going to preface this by saying I can't give any personal advice, and neither can Andy. So I'm going to give a very general answer to this, conceptual answer. Good afternoon. I can borrow 50% of my Roth 401k as a loan, interest paid back to me. Good idea? Bad idea? Not personal advice, though, I know. So I think with any, generally, and I'm going to even remove the layer of the specificity that Sean has brought to the table. I think anytime you have tax advantage assets that have some equity in them, meaning thereby the holder of those assets, the trustee allows you to take a loan against them, is something that you have to think through and understand why you're doing that. Is there a reason that you wouldn't be using another source? In one case, you could say, look, this is sort of a non-collateralized loan that I can take. The collateral is the value of my tax advantage asset. If I don't pay it back, then they've got the asset. So some people actually will do this, and there are protected uses depending on the tax complexion of the asset, where you can take money out for various reasons and pay it back. So I know this is frequently used by some people who need to dip into a 401k for a reason that is covered and take a loan and pay it back through payroll withholdings. And that has no, in the case of in many cases, a 401k or let's say a 403b annuity, that has no tax implication if you pay the money back. But I also want to say that you've got to take the big picture in mind. What is it for? Is it for something that's risky where you might not be able to pay it back? I would say, in general, it's a good idea to stick to those use cases where you need it. And you understand what the tax implications are, that it's not something that you might put into, let's say, a stock investment. And where I'm headed with this is avoid any type of margin if you can to buy stocks. It's really difficult. It has a cost that's tied to it. That's the interest on the monies that you've borrowed. And it can work against you. It's a double-edged sword, and it can often lead to assets being liquidated. So this is something to keep in mind, like consider the use case, consider what the interest is, consider the tax implication, and consider if that's really the place where you want to borrow the money. All those should come in. I'm not telling anyone not to borrow against their 401ks, and some of us use those as emergency funds sometimes, and I get that. But just in general, I'm asking everyone, maybe this is a quasi-personal finance hour that we're weaving in here, Andy, just to think about that holistic picture whenever you're considering how to use your assets or take a loan.
Yeah, 100%. Awesome. Ryan asks about buying in thirds. I hear Fool people often talk about buying in thirds. Can you discuss this as a strategy? So the idea, Asit, is that you think about a company that somebody is adding to a portfolio, maybe for the first time. What is the allocation they want to have in their portfolio? Is it a 2% position, a 3% position, a 1% position, maybe even the conviction to even build it up higher? And you set aside the thinking of, I'm going to buy this 3 times. And the reason that is, Asit, is because it distributes the buying points out among those 3 points in a way that hopefully helps manage emotions around the daily stock price of when you actually buy the stock. Because you buy it on one day, and then the second buy, it might be down, it could be up. The third buy could be up, could be down. But the idea is that you're setting aside, and the question is, Ryan asked about, is it weekly, monthly? Well, I think that's really up to each individual. I think generally maybe we say, roughly monthly, Asit. Let's just say you're allocating monthly or maybe, every few weeks. And the idea is that you would just say, okay, I'm going to buy it on this Tuesday, and maybe 3 weeks later, I'm going to buy my next position. So if I'm allocating $1,000, then I'm going to buy another $1,000, then another $1,000, or thinking about how much you want to build up to a position, depending if you're adding money, if someone's adding money to a portfolio or not. So there's lots of different ways to think about it. But the idea is that as opposed to plowing all the money that someone plans to invest in one company on one day, which could be very variable on if you happen to pick a day where the stock is up or down, or for whatever reason, it just helps to diversify the buying patterns of a position that we think can help manage the emotions of the individual investor. This is something that I've done at different points. Sometimes I buy a position and I don't go back to it, but I tend to say, like I did with MCore, maybe some other ones, that I'm going to try to buy this maybe 2 or 3 times over the next month or so, and try to break out my buying positions and then timeliness of those buys, so I kind of help to manage some of my emotions and I'm not all in at one time.
Yes, I agree, Andy. And I think for me, it could be weekly, it could be monthly. If it's a lump sum, let's say you got a lump sum, I always advise taking about 6 months to invest a lump sum. So you have something bigger than normal that's come in, and you can divide that into thirds. But I like this. I've never been a person who's bought in thirds. I do buy like frequently, and I'm sure it works out sometimes where I'm just going 2 or 3 times and I've filled that initial position. But I love the idea of it, which is like you make that first purchase. If it goes down, the business goes down, then you're like, okay, all right, I'm going to get a little bit better on the cost basis on my next go. If it goes up, you have the relief of feeling, okay, all right, I'm in. So I'm enjoying some gain already. I made the decision, I committed. So that's something maybe I will experiment with. I've heard you and other fools mention this strategy. I've never done it myself, but it seems like it must be a fun one to use. And
admittedly, Asit, sometimes I do it and sometimes I don't. It just depends on kind of the type of business, the allocation I want to give, my expectations about how I want to think. Do I have more money coming into the portfolio? So it varies. But Ryan, that's the idea, is that you're setting aside like maybe a schedule of investments. It could be when you get money into the portfolio, you decide, oh, the next day I'm going to follow up on this buy. But as opposed to, and for me, it's about managing emotions, because you, like you said, Asit, you can say, oh, I bought the stock at 100 and, over the next 3 weeks, maybe it's down to 96 and I bought a little lower price, or maybe it's up to 105, or I bought a little higher price. But it just kind of helps, I think, for individual investors. It helps us manage our temperament. And as we know, we often can be our own worst enemy when it comes to investing decisions.
So true. RP asks, why has ACN Accenture not participated in any of the bounce days, but has continued to sag? Do you have any information? Well, RP, I don't have any information. I mean, I've got some thoughts. One is that relative to some other companies, Accenture isn't as volatile. I think the beta, depending on if you're using a 3 or 5 year look, is something like 1.25. So 1.25. That means it's a little bit more volatile than the general market. So think of it as being 1.25 times exhibiting 1.25 times the volatility of the S&P 500 on any given day. What does that mean? It means that when we evaluate it next to some really high-flying tech peers, on an up day, it's going to look like the market's up now. My Nvidia's up 3%. My other tech stocks are up 4%. What's going on here, Accenture? Accenture's like, yeah, I'm sort of tracking the broader market, and it could be even down slightly on an up day. So this may have something to do with the fact that it's just not as volatile. I wouldn't read too much into that. It is a very solid company, one of the biggest and baddest and best the consulting companies around. So I think that's what it is. But I don't know, Andy, if you have any thoughts on that.
They report earnings next Tuesday on the 20th.
Oh, okay, there you go.
So we'll get more insight. I've said this a few different times. Is they do have some exposure to the federal government. So I'm interested to see what Julie Sweet, the CEO from Accenture, might be seeing or hearing from some of their partners at the federal government. So that's something to pay attention to. And I think in general, just wondering about consultants in a world of efficiency, how much will their clients need that demand? On the other side, like you said, it's a $200 billion company, exceptionally positioned to benefit from the need. Their AI bookings have grown very nicely over the last couple of quarters. We want to see that continue. So as client in a complex digital world of cloud and AI and lots of different innovations across the landscape, their clients are going to need to have some help. Asit, and I think Accenture will be in that spot to be able to deliver for them. They generate lots of cash flow and they pay that dividend, and I expect that to continue, and they buy back a good chunk of that stock. So it's not the fastest growing business, but I think it can be very efficient. It's just that right now I think the market is saying, how are they going to continue to navigate this world of if some of their companies, their clients, and their federal government are just kind of rethinking through some of the growth and some of the demand for some of their services.
Agreed. Okay, so we have a question from R2D2. The Cyber ETF CYBR has these stocks and more. What are your thoughts on CrowdStrike, Okta, Fortinet, Cloudflare, Palo Alto Networks, Zscaler? Any favorites and why? I'll just say this isn't a bad looking group. What you've isolated are some leaders in their respective disciplines. I think, for me, CrowdStrike, having the Falcon platform and a pretty decent generative AI tool to help analysts, that is security analysts, those who are working in IT departments, do their job with more efficiency and more precision. I think that's been really impressive, despite the problems, Andy, that it's had, reputationally over the last year. Okta has been surprising. Their OIG product, identity governance product, has been a hit. Andy was just pointing out in one of our chats just a few weeks ago, like, Okta's been doing well. It's looking good. And of course, as soon as he said that, before I had a chance to look at it again, I'm very fond of this little company, up some 20%. Fortinet, they have a very strong position in that network security space with custom chips that go into the hardware firewalls that it offers. And it's made a nice leap into the software side of the business. So while there was some negative sentiment on Fortinet and its ability to be a player outside of hardware about 12 to 18 months ago, that's largely erased. So that company is doing well. Cloudflare, often a very highly priced stock, but a company whose depth in edge cases and providing content on the edge is going to play well in an AI future when more of our devices will be doing some of the AI on device and then communicating with cloud. Palo Alto Networks I've never followed as much, Andy, so I don't really have a comment there. And then finally, Zscaler. I think, Zscaler, always a well-run company, very strong, has not been in the limelight as much compared to CrowdStrike, but then some of the tools that they have also play in very well. Their zero trust architecture is turning out to be pretty good at fighting prompts and the malicious activity of prompt injection. So now they have extended their offerings to protect how LLMs behave. So every one of these, I think, has something positive going for it, and they're all very solid. I just don't follow Palo Alto Networks, probably to my detriment, haven't studied that more over the years.
Okta's done a really nice job.
Yeah.
After some rough patches, they had a security breach, understanding how they're managing their workforce, their client base, how they can be competitive. Will Microsoft just, completely disrupt Okta? We use Okta, the Motley Fool. We continue to use them, and it's just they've done a really nice job managing that business and building out to their strengths. So I'm really, I respect what they have done, and the stock has rebounded really nicely, Asit. So
yeah,
it's
totally
not quite the deal I think it was a little bit, but it kind of got forgotten about a little bit. Like I think, for different reasons, when CrowdStrike was completely dismissed last summer, and now it's rebounded off those lows. Okta, I think, has kind of been like, is it really a leader in the space? And I think it's demonstrated more and more that yes, it does have some of those intellectual capital properties that are very valuable. And that guy, I think, kind of got forgotten by investors. And often those are really nice cases to try to find, what you can find, as we talked about, Asit, you and I, and you're great at helping us think through that, trying to identify those assets at really reasonable prices that the rest of the market, might have forgotten about. I think Zscaler was maybe a little bit of the same way. I own many of these, and would continue to still hold them. And I think the most recent one I bought was probably Fortinet.
Right. And Andy, it's an interesting group too, because to me, cybersecurity is hard. It's so disruptive, and you have the potential to be disrupted if you're a player. But all of these have been around and have shown some staying power. And there's not a one on this list that hasn't had a challenge where we've seen the stock really take a beating. And that question is asked out in the marketplace. Okay, is this company really going to be able to be one of duration and to provide its products years from now? And I think each one of these in its own way has sort of answered that call. So a nice little group there.
Player Sluck, very quickly. Player Sluck had just asked, and thank you. Welcome to the Motley Fool Player. Hi, Fools. Is MCore and Sterling expected to increase demand for their construction surface? It is. I think not nearly as high as 2024. So, and I'm not expecting that. Neither is the market, and that's why the stocks are selling at much more reasonable valuations. But they, as U.S. predominantly U.S. construction, data centers, buildings, more efficient buildings, other infrastructure that is needed and probably will continue to get support in some way, Asit.
Yes.
Both those companies will benefit. MCore much larger than Sterling, and they play in different spots, but I think both have attractive upside potential from here. It will go mostly on just different parts of the construction market, and that might exhibit some of the volatility in the stock prices.
It's funny, Andy, the construction market is a lot like the AI data center market. And of course, they have an overlap of a Venn diagram there because the data center build out is a subset of construction, US construction. But they both have this sort of same overhang from investors, which is a really strong outlook, but sort of compressed ability right now either to service that demand, or the idea that, well, what if the demand fades within 4 to 5 years? And I think in both cases, both the larger industry and that subset that's in data centers, the answer is probably the core demand is going to be there. There's no turning back now that we're all using these AI tools and businesses are as well. There's really no turning back from that. So the data centers are going to have to be built. It's just, again, you could argue, is it going to be a 20% compound annual growth rate for, take any metric you want in data center build out, or is it going to be 18%? I think we're really playing with a few percentage points here or there. So when we look at companies like MCore and Sterling, both of which have part of their business tied to this build out, my conclusion is they're still going to be beneficiaries of that demand. And yeah, there could be some dynamics where the pricing is favorable for investors because the market has sort of soured near term on the pace. Those are opportunities. They're not reasons to turn away and ignore the businesses like these. I think it makes the case a little stronger when the pricing becomes a little bit more reasonable.
I think that's right. That business is not going to double for them. It's coming off a very low base, and then all of a sudden it exploded. So it's the marginal increase is going to be much smaller, but and the market is expecting that. So I think any upside and any chance they can use that to be able to continue to get more efficient and get more profitable, as I think both these companies can do and can make smart investments. I think that's where some of the opportunity is, Asit, that I think maybe after a very, very good 2024, the market has sold off and just said, well, it's not going to come back, and that's okay. So now it's an opportunity for some investors to think, okay, well, if I look at, like you were saying, for the next 3 to 5 years in the data center build out and other spots in the market, there's going to be demand there. Not like it was in 2024, but that's okay. We don't need it to be.
Right. Andy, I want to make sure we grab this question from Foolish Investor before the hour runs out on us. I staggered monthly during Motley Fool repeat recommendations in 2021, staggered buying, and still got huge losses. Since then, my lots are smaller and spread over longer periods. I want to say something, Foolish Investor. I did too. I staggered a lot of buying in 2021 on a lot of Motley Fool recommendations, and I had some huge losses on those positions. I think it was sort of, in a way, a unique year in some ways. We were coming out of the pandemic, and it was just a wipeout year for so many companies that were tech forward. But I did the same thing you did, which is I kept buying, and I tend to take very small position sizes. I have very low position sizes on an entry point. Andy, I have what I call peanut shells. Sometimes it's just a minuscule position. And I do tend to spread things out over time. I think at the end of the day, if I had to identify myself, if no one was looking, if it came to it, I would say, yes, I am a dollar cost averager. And I'm kidding, of course. I'm proud to say that. So I think this is this successful strategy in investing, what Foolish Investor is saying, hey, look, I took a loss, but I stayed in the game. It's Andy, you were talking about the importance of that earlier. He or she, they stayed in the game, kept buying, spread many positions over many companies, and continue to do that today. What are your thoughts on that?
I think that's right. There was an interesting study in, I think it was the Wall Street Journal, talking about dollar cost averaging versus lump sum. And the study essentially was during overall dollar cost averaging wins marginally. In down markets, lump sums tend to work a little bit better than dollar cost averaging does. And in up markets, dollar cost averaging works better than lump sums. But overall, I think dollar cost averaging essentially probably works slightly better. Where studies like that miss the boat is on the emotional side, Asit, which I said. Like if you put your money in, if you put most of your money in for the year at one point and the markets are falling 10, 15, 20% over even 9 months, I just think that's very hard for many investors to kind of stomach, especially those who are newer to the market. That's why I always appreciated the discipline around dollar cost averaging, or just the idea of, as Foolish was saying, sprinkling some money in. And during 2021, that was just such a vicious time between 2021 and 2022 for all investors,
totally.
Whether it was lump sum or whether it was dollar cost averaging, small positions, larger positions, investing over a month or investing over a quarter. That was just a very difficult time. So I think looking past those times are what we have to do.
I wish I could have said to Foolish Investor, what were you doing? I made out like a bandit during that time period, but it's not the case. But this is, how we learn. And I embrace those periods, Andy, because it teaches me, it makes me a better investor. I try to study what I did right and, what I did wrong. That's how we improve. So
yeah. R2, just very quickly, Asit, I wanted a nod out to R2D2. Says, I have a cybersecurity background and own all the cyber stocks I mentioned, except for Palo Alto. Each of them has challenges. Thanks for your viewpoint. 100%. And that's the thing with every business. Every business has the challenges and has the opportunities, trying to identify those that the market's underappreciating at a price that is reasonable in the markets for the next 3 to 5 years. For me, that's what we are spending most of our time trying to think about and think through, especially when you see markets and stocks drawing down big time for whatever reason. So R2D2, you can use your experiences, as we all can use our experiences to help impact and influence our investment decisions.
Absolutely. Well, Andy, as always, this was such a fun hour. And
wake up, Toby.
Here we
wake up, buddy.
Thank you, Asit.
We put our successors to sleep as usual, but thank you all for the enjoyable hour.
Thank you all for a great hour.
I was deep in prep for what we're talking about, Jason, and I am ready to go.
Love it.
Great
Outstanding,
answers.
you guys. Have a great hour. Thank you, Asit.
Have fun.
Have
Thanks,
a nice
Andy.
weekend, everybody.
Take care, guys.
See you guys.
Hey, Toby.
Hey, Jason. We're digging in this hour. We're digging into strength, my friend.
Yeah, looking for strength, and I prepped for this. I did a strength workout, did some deadlifts.
I
Feeling
did
pretty
too.
good.
Just before the show, I was in the gym.
Yeah.
Yeah.
Getting
We're ready to go.
strong. You got to be strong for
Getting strong.
volatility, right? Well,
Yeah,
break down what the
exactly.
theme is. Tell the folks watching what we mean
We're,
by this theme.
what we mean by this, guys, we're thinking about strength in companies, strength in businesses, the companies that have that continue to be strong regardless of the current environment in which we find ourselves, and that we think will continue to succeed. Will their stock prices get hit if we hit into a recession? Probably, possibly. But we believe that businesses, what we're looking for is the companies whose businesses will remain strong and perhaps provide good opportunities for investment, will come out even better than they are now at the other end of all of this volatility and craziness we're seeing. And you can always find these, Jason. They exist and they're the good long-term investments.
Yeah, no, that's the key. And I think it's important to note too that sometimes when we get into businesses that have strength, there's no guarantee of outperformance for those businesses because often they're very mature, very large businesses, but they can be wonderful ballast in your portfolio. And a lot of times what we see is our best winners become those strongest businesses where they can still serve a really important role in your portfolio. But I don't want to sell strength short either. There's some incredibly strong, durable businesses that can absolutely deliver market-beating returns over the long term.
Oh, yeah. Yeah.
All right, let's set everybody up for success here as we get this going.
Let's do it.
We want to take your questions too about the concept of strength and other things. A lot of you that have been watching us for a long time, you know what Toby and I know, and we both have a good bit of knowledge across a lot of industries and sectors and different companies. So ask us those questions in our Slido. We're on YouTube now too, right? So we're on YouTube and we're also behind the paywall for Motley Fool members. So we have Slido. It's a single forum you can go to get questions to. Go to slido.com. The event code is Fool24. All one word there, Fool24. Get your questions into us. Most importantly, remember that we will answer as many of these questions as we can that we are capable of answering. We don't want to give bad answers to good questions just because you're asking. But remember, when we answer your question, we're not telling you what to do. We're not providing individual investing advice or personalized financial advice here. Just sharing our insights and expertise and knowledge. Own the decisions that you make about the questions that you ask. And maybe we inform into that. Maybe we don't. So Toby, where do you want to kick things off?
Let me throw out a company that I've been looking at recently, Jason, that I think is a strong business based on past performance. That's TJX Companies.
Yeah, love it. Absolutely love it.
This is strong. This is resilient. Now, let me preface it by saying they will probably have challenges in a high tariff environment, depending on how it goes, because they have built a very extensive, very robust sourcing and distribution chain that stretches across the world. Potentially tariffs would impact that to some degree. But I think the building of that over time has shown that they can probably adjust it over time as necessary to continue to do what they do well. Well-run business. The brands tend to be distinct, though they do have a lot in common.
TJX Companies is TJ Maxx.
TJ Maxx.
Home Goods.
And there's another big one I'm blanking on.
So is it Marshall? It's not Marshall's, is it? I gotta look it up.
Yeah, we could look it up real quick.
They
have a decent international presence.
Yeah.
This has been a retailer that has been good at international expansion when they've gone into it, which is one thing I like. The other advantage they have, Jason,
Marshalls. So it is in the U.S. It's TJ Maxx, Marshalls, Home Goods. Home Sense is another one that's fairly recent. And then here's the thing: the European, and it's in Australia too. It's not TJ Maxx; it's TK Maxx.
Yeah. Wait. Yeah.
No, it really is. It's TK Maxx. It's not TJ.
Yeah. Yeah. It's different strokes for different folks, right?
Yeah.
People tend to trade down to them too in times of recession. So you do see some of that happening. You see some, as their core consumer gets pinched and is perhaps spending a little less, because much of what they'd offer, Jason, you could describe as discretionary in a lot of ways. So as their core customer might get pinched in tough times, you do see some trading down that occurs, which tends to replace that revenue in tough economic environments. So they tend to do pretty well in tough times and in good times too.
I don't want to say they're counter-cyclical.
I wouldn't say that. I would say it's
certainly you don't see them take the same hit during weak economic periods that you do for other companies that are largely focused on discretionary retail, high fashion, not even just high fashion, but just upscale fashion always gets hit hard during recession. Higher end home furnishings also tends to get hard when people are pulling back. Those are just large ticket discretionary spend for the home. Those are areas that kind of get hit and pull back more. I think the thing that's really interesting to me about TJ Maxx, I'm going to look back over the past, let's go back to like 2010. So,
all right,
let's go back to 2007. I want to go back to like before the financial crisis. We go way, way back. And I'm going to share on the screen here. This is a chart of TJ Maxx. Natasha, if you can send that up when you have a chance. So this is the purple is the S&P 500. Excuse me, the purple is TJ Maxx, and the yellow is the S&P 500 index. So what you see is that when the market falls substantially, 20% declines, you usually see TJX company stock fall similar to what the market does. Similar to what the market does. And over the long term, again, since 2007, extraordinarily good, right? We're talking nearly that might be close to more than 4x the market over that same period. And on an annualized basis, the market's done right at 10% a year. It's done almost 18% a year. The power of compounding and outperformance over the long term is remarkable at creating wealth. And this has been one of the big winners. And there aren't a lot of companies out there that do have a little, especially in retail, that have a little bit of counter-cyclicality where, again, they hold up better than most, I guess is the key, but they really stretch out their legs when things are going well. So some fundamental things about the business you were talking about that I want to build on to talk about where the strength comes in. Number one, the value proposition of the business. You're not targeting people on the lower. Your target shopper is not on the lower strata of the income band, and that's really important because if you're selling discretionary goods, you want to appeal to customers that have flex in their ability to have discretionary spending across the economic environment. That doesn't mean that's not their brands, their retail brands are not appealing to people of lower economic strata. They absolutely are, but they're also compelling across the strata, right? All the way into higher earners, because there's that value that they create. Plus, a lot of shoppers love the hunt, right? The treasure hunt aspect of their business. Not very many things that they sell in their stores can you order on the internet. You have to go into the stores to get them. And that's actually part of for home goods, their home furnishings business. That's actually a big driver there, is because you have to go to the store and find it and buy it. And that helps in a couple ways. One way is that it helps a lot for those items is it reduces returns. And for a business like this, where you're buying wholesale goods, largely from like retailers and distributors that they're just looking to offload it, you don't have a vendor to send it back to, right? So you want to minimize the cost of returns as much as possible, lowering the thresholds for returns. So they do those things very, very well. They turn over their inventory incredibly quickly and replenish that. So inventory turns for retail business, where you don't have high margins, but the more you can turn over your inventory, the more you leverage your operations, right? And you generate on the smaller margins, you turn over more revenue and you generate more profit and cash flow. So they're very, very, very good at that. They're exceptional sourcers and buyers. You hinted at that.
Yeah.
They're exceptionally good at that.
Yeah.
They're good at buying things that they can sell quickly at a price where they can make money, right? Where they can buy it for a good price. They can get it into their stores. They can turn it. And if inventory's in stores and it's not turning, but it's turning in another market, you know what they do? They get it where it's going to turn.
Yeah. They're very good about repositioning inventory very quickly.
Yeah. Yeah. And there are very few things in retail, and Walmart's kind of the gold standard for that. And I would put TJX in the Walmart echelon of companies that are good at that repositioning. So they do all of those things really, really well, Toby.
Yeah. All right. You want to hit questions, or you got something you want to throw out first?
Yeah, let's hit some questions. I know we'll talk a little bit about Berkshire too, and how Berkshire's built strength into its business. Yeah. But we do have some questions.
Yeah, that's a good one.
Yeah, but we've almost 250 questions in the queue total, so we can answer questions that are coming in that are more recent. We can kind of go back a little bit too. All right, let's see here. This one just came in from LC. How will foreign stocks like Shopify and Mercado Libre be affected with current tariffs and tensions between the countries? So this is interesting because I want to start with Mercado Libre because that's the easy one to answer. Mercado Libre is headquartered in Buenos Aires, I believe, in Argentina, I believe, or is it Brazil? I can't remember. It's either but they operate in 18 or 19 countries in Latin America. Mm-hmm. So I won't say they're completely shielded from tariffs, but I think it has almost no impact on their business in terms of what's going on with the U.S. trade disputes with our border neighbors and with trading partners abroad. I don't think there's
Buenos Aires, Jason, by the way.
Yeah, it is Buenos Aires. Okay, so I don't think there's any implication for the company beyond if it's sourcing products for its Mexican customers, because they do have some substantial and growing operations in Mexico from the U.S., right? Because if you're bringing goods, I know that Mexico has put in some retaliatory tariffs on American goods imported into Mexico. So beyond that, I don't know that there's really much implication at all. I want to encourage people to go back to yesterday's replays. Danny Venna and I spent an hour with Federico Sandler, who is the former head of investor relations at Mercado Libre, and he's a real expert in Latin America. Has lived in multiple countries there. I think he was born in Argentina, has lived in Brazil, he's from Argentina. I think maybe he was born in Mexico, but he has ties and has lived in multiple countries in Latin America. And he's native to that part of the world. So he's truly an expert in it. So I would encourage people to go watch that out. I mean, it is a real masterclass on Mercado Libre, Nubank as well, where he spent some time working in IR for Nubank. But just talking about the opportunity for e-commerce and banking and fintech in Latin America broadly. Excellent conversation that's worth checking out. Shopify, it's a little bit different story. That honestly, I need to do a little more research on the implications because Shopify is a Canadian-based company, headquartered in Canada.
Yeah. My gut, Jason, tells me Shopify would not get hit too hard.
Right. Because it's mostly what the things that the tariffs are largely placed on are natural resources coming in from, I don't know if it's a blanket 25% tariff. So there could be some impact, but where the impact is for Shopify that's indirect on Shopify's business, but it would have implications for their cash flows and revenue, are merchants that use its platform where the goods and services that they're buying and selling would be impacted by tariffs. So, for example, if you buy, I'm just going to pick something really random. There's this company that makes these really cool toothbrushes. It's electric, but the brushes are shaped like a U, so you've got the bristles over all your mouth at the same time. Those are made, I believe, in China. It's a U.S.-based company. The goods are made in China, and they use the Shopify platform. And you can buy on the Shopify platform, You can buy using the ShopPay app, where everything's processed through Shopify. You can buy on their website through ShopPay. You can buy on Amazon too, by the way. They have an Amazon store set up as well. So here's the way that would affect Shopify. If you use ShopPay to buy it, Shopify earns a take rate, right, on the goods that they facilitate the transactions for. They earn transactions fees. And if there's headwinds on those transaction fees, if people spend less money, if we see this up in the economy and it pushes revenue down for those buyers, it would weigh on the transaction fees part of Shopify's business. So that's like a second order effect. If we do see this cause consumer spending to really pull back, right, then it could affect that part of Shopify's business. The majority of a bulk of Shopify's revenue is the services that they provide, the flat fee-based services, and not just a take rate on the gross merchandise volume. So there's a little bit of an impact. It's largely like second order based on whether it creates headwinds for revenue growth for their tenants, or excuse me, for their merchants. So I think of it mostly as just kind of noisy and maybe creating some economic challenges for the small businesses that are using the platform. But honestly, having a platform like Shopify to help with keeping your inventory, running your business. This is the operating system for so many of these merchants, right? This is how they run their business, so much of their business. I think it's the sort of thing that could help their merchants survive through these sorts of environments, where other merchants that have piecemeal systems that they put together maybe don't have the same advantages. So I think it's just mostly noise, and it's not going to up in the things that make Shopify such a powerful, strong business.
Right.
Any extra thoughts there? I think that's basically it, right?
Yeah.
Yep.
Now, yeah, I think that's basically it.
I mean, billions and billions of dollars of gross merchandise volume across the platform are going to be affected by tariffs because of imported goods that these sellers are selling.
And it's ultimately going to depend on the amount of volume reduction you see.
Yeah,
in
that's really it.
Their customer businesses as to how that impacts them. Could be an opportunity for them too, right, to roll out a new service.
Okay. Besties just pointed out too, Mercado Libre moved to Uruguay. Thank you.
Did they?
Okay.
Like, did the corporate headquarters move there?
So, I mean, maybe they moved their domicile there.
That's what I'm guessing. Well, they do say their headquarters are located in Uruguay.
Okay. Yep. Couldn't remember. I knew that there was a move. I couldn't remember where. Thank you, Besties, for sharing that.
Okay. Yeah.
Yeah, it's funny. The Brookfield, I believe it's the asset manager. Did Brookfield Corporation move its headquarters to New York? Or was it Brookfield Asset Management? I can't remember. Maybe both.
Now Mercado Libre does have a data center in the U.S., Jason.
Okay.
I don't know if that would have, if there's any impact or not.
I don't know. I don't know if they're for those sorts of fees-based things what the implications are. But
I don't know. I don't know how that would work out.
Yeah. So Mark Carney, I believe, is the new Canadian Prime Minister. Big name in finance. Asking so why has Brookfield moved its headquarters to New York? That's not a good look now. I can tell you that it's not a good look at all now with everything that's going on. But I mean, New York is the financial center of the world, and I think as much as anything, that was the biggest reason for that move, is to get closer to where the international center of finance is. That's my best guess. So, yeah. I want to add more. I don't know if I can really add much more value to that. Hasn't really changed my stance on the business. All right, what's next? Yeah, no, that's right. The corporate Mercado Libre it is their headquarters. I remember now, their physical headquarters in Uruguay, but they are a U.S. It's one of the reasons their financials can be just a complete pain, is because they have to report in U.S. GAAP, right? So, and they collect in all of these different currencies, which can make the numbers a mess. But they don't tend to redomicile money. They keep because they're investing so much in those markets to grow and expand them. but when they report that's why I think you have to look at their foreign exchange excluded numbers along with their GAAP numbers, both, because they both are important to understanding the full story. But it does make their financials kind of messy because they're dealing with so many countries, and with inflation and deflation at times in these different countries, it can definitely make the numbers a little more challenging.
Yeah.
I'm not going to wade into the potential political firestorm of Brookfield and Toronto and New York. I don't think I'm going to create any value, and I might make some enemies. So I'm going to keep my mouth shut. I'm going to keep my mouth shut there. So anything, what do you see next here, Tobe?
Let's see here. Tesla versus BYD. Jason, it's a question from Sadah 46 minutes ago. Tesla versus BYD. I think this is an interesting one because we could think about which one of these might have the stronger business in the face of trade wars. Honestly, given the current situation, I would probably give the edge to BYD, because I think what we're seeing is that right now it tends to be the US versus the other developed countries to a large degree. And there's less friction at the moment between China and some in Europe, say, where BYD is making a big push for expansion at the moment, building several factories out there. And BYD,
not even Europe. I think you get into Latin America, for example.
Yeah, Latin America as well.
And African countries, the couple dozen or so African countries that are showing a lot of economic growth, and their middle classes are expanding.
That's right.
China is making inroads there, while the U.S. is building walls around itself, is becoming more insular. And I think that's
probably helpful for BYD.
Right,
BYD has a more diverse product base than Tesla, which probably helps them. BYD is a supplier of batteries to Tesla, for instance, in China.
Yeah. Well, they make hybrids, they make fully battery EVs. So yeah, they have a far more expansive lineup.
And the big thing, Jason, right, is look at the direct cross between the two businesses. Tesla has significant operations in China. BYD has virtually no operations in the United States. Right. If we get into a protracted trade war between the U.S. and China, for that reason, I think Tesla gets hurt more because they are in both places, big in both places.
Well, BYD, then you talk about the political implications of Elon Musk having become more and more aligned with the Trump administration. The political implications there in China are, if you're the Chinese Communist Party and there continues to be at loggerheads, that's not going to be good for Tesla. It's not right.
Now it's going to mean that BYD perhaps can't expand into the U.S. as quickly as they might have liked. Their timeline might get pushed back, but
there's trade restrictions in place, right, for these Chinese EV makers. Yeah.
And if you get in a situation where both countries say, you know what, no cars from either country are coming in, like in the worst case scenario, Tesla does make cars in China, but the risk there is a nationalization of the assets, right? If you got into a really serious trade war, from BYD's perspective, it would mean we don't grow, but it's not going to cut any existing revenue if U.S. and China really just start going at each other, right? I mean, I guess they might lose revenue in terms of supplying batteries to the Tesla cars in China potentially, but I just given where they're situated right now, given their footprints of their business, where their factories are located, where they're doing business, I think BYD looks a little bit better to me in the current environment. If you had to pick between the two.
Well, Tesla's been in the too hard pile for me for a long time.
Yeah.
And not because of the EV business, because of all of the other big bets.
Right. That's the thing.
Yeah. There's still so much of the value of the business today, even with it down pretty substantially. There's still a massive amount of the value of the business today that's tied to, I've talked about it before, artificial intelligence. On the transportation side, the autonomous vehicles and being able to monetize that with fleets, that's a big potential value driver. The robotics, looking to be a leader in industrial robotics and beyond industrial applications too, from what they're trying to do. Investors are expecting huge things from, one or more of those moonshots. And so far, besides that $10,000 a car, they're able to collect on the self-driving technology. There hasn't been much monetization from Tesla of those things, and they're spending a lot of money on development. So those things are just in the too hard pile for me for Tesla. So it's a little easier to see the line of sight with more headwinds for the auto business, while BYD broadly, I think you're largely right. They're making inroads in markets that the US seems to be kind of turning away from.
Yeah.
All right, what's next? So Bestie's got a question in here about Kyndryl. That's ticker Katie. I don't follow Kyndryl. Do you follow Kyndryl?
It's not one I follow too closely. Okay. Yeah, I should follow it more.
Yeah. They've
I haven't looked into it too closely yet.
It's been a very successful spinoff so far. There's no doubt about that. So Besties, we'll leave that question in there. Sean M asks a question that's going to be hard for us to answer, but I think we're both certainly willing to give it a try. What is the best way to choose a career so I can invest more, making a better living to invest? So one of the things that I love about the idea of this question is one of the things that I've come to realize over the past decade that has been massively, massively valuable to me is finding ways to earn more money. I mean, I love outperforming. I love finding outperforming stocks. And, I'm one of the few people that get to do this sort of thing for a living and earn a living while I'm also learning about potentially great investments and learning which investments maybe not would be great and to avoid. So that's a little bit of a cheat code, right? Finding work that can also fuel your investing journey in addition beyond the money to invest. But I do think that the idea of finding ways to increase your earnings is incredibly underappreciated to grow your wealth. Finding great stocks is awesome, but if you can invest an extra $500 a month, I don't care how good of an investor you are, an extra $500 a month you can put in your portfolio is probably going to be worth more than whatever alpha you can generate from finding just better stocks. So the mindset, I think, is fantastic. Directionally, I think one of the most valuable things that I learned in my professional life, Toby, is looking beyond just how much you can earn and try to get some alignment with your values, with the work that you do, and also some sense of purpose. It's not chasing your dream. So many people burn out trying to find their dream job because either they don't get it and they're miserable in the work that they have, or they do and all of the grandiose visions they have turn out to be wrong and they're miserable in the job that they have. You put so much, emphasis on this perfect ideal career, and just finding work that provides you some sense of purpose is valuable, right? I think as a starting point, if you do those things, you're more likely to find work that is fulfilling and you want to do more of it, right? Also, I think people should consider the idea of side gigs. There's a number of fools that come on Fool24 that do this. They have an investing thing that they do full time, and then they do this as a side gig. So stretching your legs and putting in time doing side gigs can be a useful way to generate extra income as well. Never shortchange investing in yourself too. Investing in your training, your knowledge, building skills, learn a trade. I mean, there's a massive shortage of skilled tradespeople. There's a lot of ways to earn six figures that go get a college education and $150,000 in debt. Toby, I know you have thoughts about this too.
Yeah. You hear people, as Jason, say, don't worry about making money. Pick a career that makes you happy, right? And that's you're passionate about. And that's
I hate
good.
that advice.
Yeah, that's good if you can do it. But you know what? Passion doesn't put food on the table.
No. No.
That's just a harsh reality, guys. You do have to be concerned about economics. You do have to be concerned about paying the bills. You do have to be concerned about supporting your family. And I think that this is me maybe getting a little too off the rails here, but I think we do a disservice to our children when we tell them that focus only on what you're passionate about and the money will follow, because it doesn't always follow, right?
No.
You have to have a practicality about you.
Right.
It is good to do something you're passionate about. But you know what we know, Jason, is most startups fail, right? You know, it's try that when you're young. If you want to start a business you're passionate about, go for it. Have fun, right? You want to pursue a career in the arts, spend a couple years doing that, sure. But at some point, like, you've got to have a way to support yourself. You got to have a way to eat. You got to have a way to make money. You want to support yourself in retirement with your investments. So that is important, right? That is certainly important. So I would say choose a career that you think. Now, on the flip side, I don't necessarily encourage people to chase money above all else. I think that leads to a bad path. That leads to unhappiness.
It's the other end of
right.
a kind of dissatisfaction that you have.
Right. But you can find a sweet spot, right? You can find a way to do something that is interesting to you, that is compelling, and also pays the bills. And hey, maybe you get lucky. You can find something that pays really well, but doesn't consume all of your time. And so you can volunteer, you can do other activities, you can have that side gig without worrying about it making you any money, right? That's a nice sweet spot to be in too. So there's a lot of ways to go about this, but I think that everyone, especially when you're young, needs to have in your head, I need to be able to support myself economically, right?
Yeah.
And that's kind of important, I think.
Yeah, and don't show up expecting anything. Work hard and earn it. You know, that's I sound like my dad, but that's okay.
We become our parents as we age, right, Jason?
Yeah, no, that's right. R2D2, what are your thoughts on Robinhood, ticker Hood, Palantir, ticker PLTR, and SoFi, ticker SOFI? So this is a good question we can talk a little bit about. I can talk about a couple of these companies. I will say this. I'm not gonna bury the lead. I'm gonna talk about Palantir first.
All right.
I think Palantir is a remarkable business. The software and the AI that they're still building on, but what they've built is pretty powerful and incredible. But to reach anything like the expectations that are baked into the stock, even at the current price, they're going to, and I'm going to be parroting Lou Whiteman a little bit. Lou's our friend and colleagues talked about this before. It's going to have to do a lot more business with the public sector, commercial customers, versus its legacy history with the defense industry. So to get the kind of margins and the growth that's expected, I just continue to look at it, and the current valuation keeps me from considering investing in it. I just think it creates too much risk. Because there's so much growth that's priced into the business that I don't know if it's reasonable. And that's one of the great things about the market is that, you know, I can be right or wrong and not own that stock, and it doesn't matter. So, but that's why I've avoided Palantir to this point, is because I do think the valuation is so high that it creates risk of poor outcomes. But I'm going to continue to follow it, mostly at a distance, but if it starts looking more opportunistic, I'll start peeling back open up the hood and dig in a little bit more. SoFi, I've talked about SoFi a lot. I really like SoFi. I like what they've built. Both their fintech platform things that they've built, being a payments processor for a lot of other fintechs. That business is pretty solid and grows at a pretty decent rate, generates decent cash. More recently started building a lending platform, so people come to SoFi to open bank accounts and set up trading accounts and all that sort of thing, but they largely come to borrow money, whether it's a credit card or personal line of credit, increasingly things like mortgages. But one of the things they're doing with a lot of that, the personal line of credit stuff, is they build a platform for investors to be able to to buy debt that's originated on SoFi's platform. So it's a little bit of the Upstart model, maybe to think about it, where Upstart really doesn't want to hold many loans. They hold some, like for product testing, that kind of stuff, but mostly they want investors and banks to originate and own the loans, and they just make fees off of it. So SoFi's building a little bit of the same thing. That's interesting to me because it's a way to continue to participate in this addressable market, while also as a bank not making the mistake of reducing your underwriting standards and taking on riskier loans simply to grow your loan portfolio. They're a bank now. They have a bank charter. They have to make smart underwriting bank decisions because you have depositor capital. A lot of your capital is from depositors. Those deposits are a liability. You have to give somebody money back if they come in to withdraw money, right? So they have to be smart about managing the risk of their loan portfolio. And I think they broadly have made good decisions. If you look at their growth rates, the loan portfolio is growing at a solid clip, but it's growing at much lower rates than the rest of its business. I don't think that's a flaw. I think that's by choice because management isn't lowering underwriting standards. They're holding firm on making sure that they manage the risk of the debt that they're taking on and not fall in love with the idea of spectacular growth, because when banks grow spectacularly fast, they fail spectacularly fast because they've taken on too much loan risk. So I think SoFi's built a pretty solid business. I haven't studied Robinhood very much, but I will say this, the business has done far better than I expected that it would. They've expanded their services. They've attracted a larger base of investors, and they've retained those customers pretty well. So they've done some other interesting things, right, to create more cash flow and capital with like some premium services that they offer that seem like they've been received pretty well by a lot of their customers. So whether those things have staying power over the long term, we'll find out. But I do think that now versus 3 or 4 years ago, when the business was first going public, it's certainly raised the bar for me in terms of what it can be. Anything to add there, Toby?
Not really. I like the innovation I'm seeing from them in the space, right? Robinhood too, in terms of being an app-first approach,
Yeah.
Which I think is very appealing to a new generation of customers,
Right.
for them. You definitely like what they're doing in terms of trying to simplify the user interface to make it more accessible in a lot of ways, which I think some of the legacy brokerages and financial companies, even someone like Schwab, who's like a discount broker, right? And yet,
here's the thing: like Schwab and Ameritrade, and some of these are like, for us, they're innovators, but for younger investors, they're the stodgy legacy.
Yeah, and they do have a lot of legacy stuff kind of built up into their platform that's difficult to overcome.
Right.
And so it's in some ways more expensive for them to innovate in some of these ways than it is for someone like Robinhood or SoFi. I think they're going to have to respond, and they are responding, but it's just tougher when you have a lot of legacy systems and a lot of users who expect a certain thing to be a certain way, to disrupt that too much.
So Matt had a question about one of the stocks in the Stock Advisor penalty box. Matt, that's not really something we can give a decent answer to here. So I'm going to leave it alone. Toby, what do you think?
Yeah, I can note that we're still discussing it. If we were ready to move on from it, as it were, we would have done that. But I also note that the new CEO is not even a year into his tenure. So we tend to be relatively patient. And when you see a management change, personally, I like to not be too hasty with respect to that. Give the new management time to kind of work things out and see what they can do. And then for me, that's generally at least a year, unless there's some obvious reason that you can point to say it's not happening. But we're getting to the year mark. I believe he took over in April of last year. So next quarter will kind of be, all right, now I can make some assessments on what this looks like. Do I see potential? Do I see some progress? Or is new management not the answer?
Yeah, no, I think that's fair. If my experience is that a lot of times when, especially with companies that have been winners in the past, when they go through struggles, and the whole beer industry, and for Boston Beer Company, ticker SAM, the company behind Sam Adams, their business is a lot bigger than beer. Like their other products that aren't beer are bigger. That's their bigger business. And that industry got flooded with products and got very mature. And the competitive pressures there have affected everybody. It's affected everybody's volumes. It's affected profits. They've had to be competitive on price. And giving the business time to reset usually pays off. So I think that's right.
And there are definitely some industry headwinds.
Yep.
With this, beer consumption is down.
Yep.
Alcohol consumption in general is a little bit down.
Well, we spent 2.5 years drinking everything we could during the pandemic, right?
Right. Yeah.
And things have definitely started to normalize a little bit there. Yeah.
You've got non-alcoholic alternatives that are no longer at afterthoughts. They're interesting. They're compelling to a lot of people.
They're good. I mean, we have to start there. There's some products that actually taste good. Yeah.
I have some non-alcoholic beer in my fridge that that tastes good.
Yeah.
That is
Athletic makes some really good products.
Athletic's fantastic, right? Yeah. And I have some I try from like kind of your major beer makers that I taste as like, I'm not going to drink this.
Right. Yeah.
Right. And so there's innovation happening in the alcoholic space, and it's not happening from your big brewers, your big companies, generally speaking. Athletic is a prize, Jason. I feel like someone's eventually going to come knocking and saying, how many zeros on this check? That hasn't happened yet, but I do expect them to get acquired at some point by a major producer. I don't know. And there's other parts of the alcohol industry that are starting to see some more innovation in the alcoholic space. They're not as advanced as you see in beer because it's been around for much longer. Right. But it's getting there slowly. And then you start to think about, well, what does that mean, right? What does it mean for Anheuser-Busch, for instance, if there is this bigger shift to non-alcoholic, which doesn't mean drinking soda, right? Which means drinking some of these other alternatives, some of these produced beverages that are interesting, flavorful, that are enjoyable for people at parties and whatnot. If you're an investor, what you hope it means is they look at that and say, this is where we need to go. Let's put some resources behind this, right? They haven't yet, right? In a big way. And it's a very small part of the overall industry right now, but it is growing a lot. Look at the growth rates of someone like Athletic versus your other major producers, right? The growth rates are much higher, which is kind of one reason I'm a little bit more interested in that right now. And you just can't find public companies in that space doing interesting things. So that's the trouble from an investment standpoint. But it's an interesting time for that industry, for the alcohol industry. They got a lot of stuff they need to work through and think about, and how they're going to continue to be relevant for the next century. I think they will be, but it's a time of change. And
well, as long as there's people, there'll be somebody drinking a beer, right?
Right. Yeah. And what you're seeing, right, when I say non-alcoholic is becoming more interesting and a lot of innovation, that doesn't mean that you have everybody suddenly like going cold turkey, right? Jason, it means like,
well, I mean, there's been plenty of times that I want a beer, but I don't want alcohol.
Right, because it's like a Tuesday and you got to get up early the next day and do some work, right? And you're thinking, all right, I'm going to sit down. I'm going to watch the basketball game on TNT with an
or it's Friday at 1:30 and I'm going on Fool24 at 2.
And you're not yet ready to wind down the week, right?
Yeah, exactly.
So there's a lot of crossing above, right? And
right, absolutely.
Both parts can still appeal to a broad swath of consumers.
Yeah.
It's there's just going to be some shakeout into what that looks like and what that means. That's why I think acquisitions and innovation from your big alcohol companies work because it's not a different consumer in large part. It can be the same consumer, right? You just have to figure out what product you want to offer them at what time and what way and what makes sense for you. So yeah, we'll see how that shakes out.
I think we need to do some clarification here for besties. Besties, put this in about 17 minutes ago, and I think you and I both missed it when we were having the conversation about BYD and Tesla.
Yeah.
And Bestie says Tesla, frankly, I don't think there will be any nationalization. That's not going to happen. Nonsense. Also, Musk has a good relationship with China regulatory. I think I want to put words in, I'm pretty sure you were saying that with BYD, there is a Chinese-based company. There's always the risk of nationalization, right? And not with the risk of Tesla's factories in China being nationalized.
I think that there is a little bit of risk of nationalization. I think it's very, very remote, to be clear.
For BYD or for Tesla?
For Tesla.
Okay.
I think it's extremely remote. I don't want to put it off the table, though, because things can happen if things get really bad. But to be clear, it is a very, very remote possibility. My point was that Tesla has operations and assets inside China. BY has none in the United States. BYD has none in the US. If you get into a massive, drawn-out, we're just slinging everything we can at each other, Tesla is more at risk because they have things in China. BYD has nothing in the US.
Yeah,
so,
and I think it's you're absolutely right that Musk and Tesla has built a good relationship with.
Oh, they have.
You have to. If you want to do business in China, you have to. But in regards to everything that we're talking about with everything that's happening right now between the United States and China, that is a leverage point that if the CCP decides to flex, they absolutely will. They absolutely will. So that's what I'm saying.
And again, I think like an all-out nationalization is remote, but there are things you can do.
Yeah. 5 years from now, I don't think any of this matters.
Right.
I really don't. I think 5 years from now,
it'll shake out. In the short term, could you have things like taxes? Could you have things like higher regulations on foreign operators? Yes, you could. And what could the U.S. do to like target BYD? Nothing, because they don't have anything here, right?
Right.
So it's just the structure of each respective business and where they are and where they're operating and how they've developed puts Tesla at I think in a more riskier scenario right now, based on the way things are playing that. But I think you're right, Jason. I think in 5 years, this is probably resolved.
No, I think this is
that much.
I think this is probably resolved a lot quicker than that.
I want to hit. There was a question from Rose that I saw, and now I don't see it anymore. No, there we go. It's right here.
The index funds or stocks one?
Yeah. So Rose asked, is it statistically better to add to index funds or individual stocks during downturns, or about the same result? Well, Rose, the flip answer is if the individual stocks you're adding to are big winners, that's better. If they're big losers, it's better to add to index funds. And that's unhelpful. It's
a little unhelpful, but I think
it's a little like saying buy stocks that go up, right? If
directionally, there's value there.
To be, you're going to have a wider outcome, right? I think, if I may, I would like to suggest that the bigger point here is add to your investments during downturns, just like you would add to them in good times. But don't be afraid to add in downturns. Keep investing. And I think you will find, whether that is individual stocks, whether that is index funds, I think you look back in 5 years and say, you know what? When the market was going to pot and everything was down, I got some really good deals. That turned out to be a great time to add. And I got a lot of gain out of that, right? I think that's what you'll see, that the bad times in the market are where a lot of your money is made.
I want to build on that a little bit, because I think here's my experience going through market downturns is that we see some goes to cash, right? Some people sell on the way down and they pull back and they go to the sidelines, right? And wait for the bottom to reinvest or whatever. But we also see a lot of rotation where people sell their riskier things or the more volatile ones, and they buy the Walmarts and the Costco's and the blue chippers of the world. And now, obviously, Costco's been a long-term winner. Walmart's been a long-term winner, but a lot of that money will flow to I don't know, like the Procter and Gambles of the world, some of these, give me another good one. I'm drawing a blank here. So like General Mills, like those kind of companies, like those consumer staple businesses, a lot of which have not been great performers over the long term, but they're viewed as safe, right? It's a good, safe place to go. You can get some dividend yield, and it's the safe port in the storm, right? So the downside of that is they're still going to go down, right? But a lot of them don't go down as much as the market, and then they tend to underperform, right, when the market does start to recover. So what you do see, in my experience, as a foolish investor, building a portfolio largely built on growth, and owning lots of stocks that tend to be more volatile than the market, is that when we do go through downturns, like we've gone through here for the past 6 weeks or so, some of my biggest winners and some of my favorite holdings fall more, right? Because they've done really well, and now investors are like, all right, well, I need to sell now before it falls more. I don't want to give up more of those gains I've made, right? So this myopic view of this one stock, and it's my money and my gains, and I want to make sure to keep them. But the result is it sends them down faster, and they fall more than the market. And we do get those opportunities to buy those excellent winners that have fallen more than the market, because inexorably, when the market does turn and we return to growth, they're great businesses and they're winning businesses, and they continue to win, and the stocks move back up more, right? So it is a good way sometimes to supercharge your portfolio. But to Toby's bigger point, the biggest mistake a lot of investors make is waiting to buy just on downturns. And, if the market doubles and then it falls 20%, it's still up a lot more than it was, right? From that beginning point before the double. So, think about where we are now, from the bottom in like October of 2022, the market's up, 65%, and we're down less than 10, like 8% now, but 10% down. You still missed out on 40 or 50, I think 48% in gains is what you missed out on waiting just to buy a dip. So the
Jason,
danger is trying to catch the bottom and trying to get the perfect price. That's the danger.
Over the past year, like from right now, over the past 12 months, the S&P 500 total return is up over 10%.
Yeah. And that's even with the sell-off.
Yeah.
That's even with the sell-off. So here we are going through a little bit of a correction, and we're still basically average. This is an average year, even with the sell-off, right? Yeah. There you go. All right. You got another one? I've got one I can grab.
All right. What do you want to hit next?
So SB is giving us some stocks to rank. I love playing the ranking game here.
You know, rank. Let's rank.
So SB writes, how would you rank the following stocks that had sharp pullbacks on their potential to beat the market? I'm going to tell you right now, SB, I'm not going to touch the 1 or 3 years. I'm going to go straight to 5 year. Being mindful, because we don't know what the market's going to do in the near term. Don't know what the economy is going to do. So I'm just going to focus on like the longer term. UPS, that's the ticker. PayPal, PYPL. The Trade Desk, TTD, and then Transmedics, TMDX. I love this cornucopia basket of vastly different businesses, right? So thank you for that, SB. Toby, you want me to go first? You want to go first?
Why don't you go first, Jason?
Okay. I'll go first, and I'm going to do this. So I'm going to change the wording of my answer. So you said on their potential to beat the market. I'm going to, using potential, I'm going to say, what is the probability that they beat the market, right? So let's just start from there. What is the likelihood that these businesses will beat the market? I will say the two that I put is the most likely to beat the market. First of all, I think the Trade Desk. I really believe they're going to figure it out. I think Jeff Green they're going to figure it out. They're having problems moving people from Kokai to their new platform. I think they're going to figure this out. Change is hard. Change management is very, very difficult. And there's a lot of big customers that have millions and millions of dollars that they spend on on that ad platform. That's the core of their advertising business, or a substantial part of it. that they're very reticent to make a change in that process that's worked well for them. So I think Jeff Green and team are going to figure that out. So I would say the trade desk first. Transmedics is taking a risky move in building out its own fleet of aircraft to move organs. This is a big risk they're doing, moving away from commercial aviation and trying to get on flights, at whatever cost they can to transport organs from the donor to the recipient patient. Their technology is, by everything that I've read and understand, is better, and it results in more viable organs getting to people that will die without them. That is a powerful business. I do think that if they are smart about the way they roll out the logistics part of their business that they're building, and it gives them additional operating leverage and predictability, it could unlock a tremendous amount of value. Now, again, I'm answering on the question based on what I think on their likelihood to beat the market. I do think Transmedics of all of these maybe is the most binary. There's in terms of the risk of what they're doing, because if it doesn't work out, they've made some big investments that are not going to deliver return, and this is probably the stock that's also most likely to end up lower than it is now than it is in 5 years. But in terms of being able to beat the market, I think it's more likely to beat the market than UPS or PayPal. I do think UPS and PayPal are probably the two most likely to be profitable investments for investors. From their current valuations and prices, the improvements that we've seen with Alex Chris at PayPal and the things that he's done there to really refocus and be hyper-focused on where they can create value and be profitable and grow their relationship with their most engaged customers, and get some beachheads established in payments beyond just like their payment processing. And then UPS is having to shrink to get bigger. They're having to pull back and focus on more profitable parts of their business. And I think they're making the right moves there. I think the floor for these two businesses is probably higher than for Transmedics and maybe for PayPal, or maybe for the trade desk. But I think Transmedics and the trade desk have much higher ceilings in terms of their potential. So I hope that's a useful way to answer it. I wasn't dancing around your request. I wanted to put the nuance in there that I think is important, because these businesses, not just the sectors, but as investments, you're looking at very, very different. I think you need to have different expectations. If you own UPS and you own Transmedics, you have a high risk reward with Transmedics to be a multi-bagger investment. With UPS, you're expecting a little bit of a turnaround and solid results from a really important business to get you maybe around the market, or maybe a little better than the market, but very, very low probability of losing money over 5 years. So you have to have a very different framework of how you think about it. Toby?
I would rank him. I agree with what you said, Justin. I agree with the categories, the two categories you got there: high risk, high reward versus more likely to be profitable. I would rank him like this in terms of potential to beat the market. Trade desk number 1, UPS number 2, Transmedics number 3, PayPal number 4. I just swap. I'm a little. I think Transmedics is a little bit more risk in there, which makes me kind of bring down like the likelihood of success multiplied by the potential if they do succeed. I think brings that it down a little bit low UPS for me. I think, but there is definitely a lot of potential there. Fair to be clear. PayPal. Can I just go on record by saying I think PayPal probably loses to the market over the next 5 years?
Yeah, no, I'm not gonna argue that, but I think it can still make money for investors.
I think they can still make money.
Yeah, yeah. No, that's how you need to take that to the prediction show later tonight, though.
I should take that to the prediction show.
There's your idea. Well, Toby, we're out of time, buddy.
All right, we are.
All right.
We're back in an hour. Jason and I to take you guys through some earnings for the week. So come join us for that. And now we got Jeff and Brian Orelli talking about some interesting things, I hope.
Valuation hour, right? I think this is the valuation hour.
Yes, it is.
Yeah. All right. Well,
right. Get the hard valuation questions in, my friends.
All right, guys. We'll see you back in an hour.
All right.
Brian, how are you? Good. How are you, Jeff?
I'm doing well. Happy Friday.
Happy Friday.
I think everyone's probably looking forward to the weekend. Closer we get here on the East Coast, a couple more hours, and I think everyone's off from work and we're there. So welcome, Brian. Welcome, Fools. We are going to talk valuation, answer questions that come in. We are not going to give individualized advice because that's not what we do here. We just try to help investors think about the world of investing in stocks, and specifically this hour, valuation. I think we each have a couple maybe companies in mind to talk through. If you have any questions related to valuation or anything else, slido.com, and the code is Fool24. Feel free to get your questions into us, and we'll do the best we can to answer them. So I'm happy to start wherever you want, Brian. If you want to dive into thinking about the valuation of a specific stock, I have one in mind we can talk through. We can take a question that's in the queue. Where do you want to kick things off here?
Why don't you start with your stock, and then I'll go with my stock, and then that'll give us time to get questions into the queue.
Perfect.
So throw us with any companies that you'd like us to try to work through the valuations of and see whether they're undervalued or overvalued. I'm mostly a healthcare person. And Jeff, you're sort of all over the place.
I am sort of all over the place. That's a good way to describe me, Brian. Yeah, I don't have any particular area that I focus in, but I love conversations about valuation because one thing I've learned is everyone thinks about it a little differently. Everyone takes varying amounts of time and energy to devote to things like valuation. Even just here around the Fool, Brian, you and I both know some investors who think very carefully and thoughtfully about the price they're going to pay. We have other colleagues who think less about it, or at least are willing to take a little more risk on as it pertains to valuation if they see a long-term growth market in front of that particular stock. So I wanted to talk through DocuSign because it's a stock that I don't own anymore. I owned it years ago for a brief amount of time, but I follow it pretty closely. I'm the ticker guide for it here on our boards on the Motley Fool site. And it just reported. And I thought, because it's on top of my mind, because it just reported results, I've been watching it for a while. It might be a fun one to talk through. So just real quick, if anyone doesn't know what DocuSign does, the name kind of gives it away. It is a document signing platform. I don't know. I've used it before in my life, Brian. I'm sure you probably have too. It feels like, in my experience, I end up using DocuSign on the things I have to sign that are very important. Like when I've signed for things like mortgages and stuff like that, or legal documents, it's been DocuSign. And I think that's a part of the bull case for the company. Part of the bear case, though, at least for me, Brian, is I've also signed a lot of documents using a number of other competitors. Now, they are the less important things in life, but I do feel like it's a fragmented market out there, even if they are maybe the leader. So anyway, that's a little bit about what they do. It'll be interesting to see how they are continuing to implement AI over time. A few years ago, before AI was a real big thing that we all talked about all the time, they were trying to implement it in their agreement software, like trying to help use AI to look at a contract and see what has changed and highlight those changes for the user, just trying to make what can be a very arduous process a little more easy to digest. So anyway, that's a little bit about the company. So I'm mentioning all that because I want to get to the results briefly. The revenue growth is starting to reaccelerate slightly, nothing crazy, but everything else with this company grows pretty nicely. And I think it's stuck in my brain as one of those pandemic stocks that shot up so high in 2020 and 2021 and hit valuations that I don't think were ever warranted or justified. That when you go back and look at where it is now, it's interesting to see that it's in a very different place. And I think a place that's a little bit more compelling as an investor. So let's start by talking through one of the things I like to do when I think about valuation, Brian, and that's I like to look at the past a little bit. I like to look at the past through the lens of where it has been in terms of valuation, but also I like to use the median ratio, not the average, because I think it just gives me a more accurate number that kind of takes out some of the extremes. So just some quick data on DocuSign to kick things off here. Currently trades at 6 times sales. Over the past 3 years, the median price to sales ratio has been 4.5, and over the past 5, it's been 6. So I would say when you look at price to sales, it's been trading pretty close to where it has been in the past. If you look at price to earnings, you can't do the median because it hasn't been profitable long enough. But so I like to go to price to free cash flow when I can't use price to earnings. And on that metric, it's trading for 20 times free cash flow. And the 3-year median is 21 and the 5-year median is 28. So right off the bat, just as a starting point, if I was looking at this company thinking about valuation, I'm looking at it's cheaper than it has been on average or on the median for the last several years. Now, that's half the battle, at least as I look at it. Because then the question is, well, where's it going to go next? And to me, a couple things I take into consideration. It does look like things are starting to head in the right direction after some post-pandemic pain. But none of the growth here is like hyper growth, super impressive growth. It's sort of just steady, profitable, cash generative growth. So I'd be comfortable from a valuation standpoint buying or adding here if I were looking at this stock as a potential investment or if it was already in my portfolio. But I'd also be keeping an eye on it because I feel like some more attractive valuation points might be presented to me over time, especially if we see a prolonged down market here. But there's nothing about it that screams overvalued, at least because all I'm doing in this scenario is like kind of looking backwards and then projecting forward on a very simple basis how I think the growth is going. Now, if this were growing 20, 30% on the top line, and customer growth was more like 20 or 30 and not 10 or 15, I might be more inclined to say it's cheap right now, right? Because I'm projecting out a little bit more growth that makes those valuation metrics a little bit more attractive. So I want to stop there. I want to let you chime in. I don't know how well you know this company, but I'm just curious, like, as you think about valuation yourself in the stocks that you look at, do you do anything similar to kind of where my head is, or do you have a completely different process?
Yeah, no, I mean, I think for companies that have products, right, which a lot of biotechs don't, so we can't do that sort of process.
Yeah, it's a lot hard. I want to hear how you do it.
I will. Yeah, so I specifically picked a really hard one to try to figure out, but we can walk through that. But just in terms of when companies have products, I tend to look at whatever metric you want to use, price to sales, PE, free cash flow to price to free cash flow. And then I like to go look at the history of the company and look at the changes in the price to free cash flow, and then look and see what the growth was at the same time. When was it valued the same as it is now, and what was the growth then? And then if the growth was much higher than it is now, going forward, then that implies that it's probably not cheap, right? Even though it may be cheap on a historical basis. Yeah. And then if it is, if it's growing faster than it was that back then, well, there's factors in here that, you don't necessarily expect it to revert back to that old price, but at least you have some sort of sense of history of what does certain amount of growth expectations look like in terms of value, in terms of what company or what investors were valuing the company at.
Yeah. And I think another thing that popped into my head as you were saying that, another thing that I like to look at is just competitive positioning too, as I think about what might happen in the future. So like one of the things that I mentioned, it gives me pause about DocuSign is it's not the only software out there that you can use to sign documents. And just interestingly, another company I was looking at earlier today to kind of compare DocuSign to is Adobe, which also reported, I think, earlier this week. And Adobe does a lot of things. I think most of us know it from using PDFs on our computers. And also if you're a creative person, maybe you've used Photoshop or Adobe Premiere or Illustrator or something like that. But they also have a document signing part of their business. And so I was comparing the two, and it's interesting. They are compared to their historical means and averages, they're both trading lower than they have in the past. Adobe's a much larger, more mature company with a longer track record, a little more stability. DocuSign's a lot smaller. Their growth rates are kind of similar, a little bit slower growth on the top line anyway for DocuSign. But I think what gives me pause for both of them, and I am an Adobe shareholder, is when it comes to the document signing aspect of their businesses. Like, I don't know the competitive advantage one has over the other. I give the edge to Adobe because a lot of us have that on our computers already for other reasons. And I think that's like a built-in advantage if you're looking to sign something digitally. Like, why would you go sign up for DocuSign if you're already a subscriber
to the Adobe product. But that's another thing I like to think about is like, what's the competitive advantage? How easily is this disrupted? Who else is in this space? Can there be multiple winners, or is this a winner take all kind of market? So these are all the things that go into me thinking about DocuSign. It's one of the reasons I've held back on re-entering as a shareholder after selling my shares a couple of years ago.
Right.
Yeah, go ahead. You want to do yours? We had a couple
questions
too. We can come to later.
Do mine, and then we can, because maybe I can actually use this again for the questions. But I gotta explain I got a spreadsheet, so I gotta explain the spreadsheet and how it works. Okay.
While you're doing that, I'm going to look up some of these other tickers and try to get some data so we can talk through some of the questions in the queue.
Right.
What stock are we going to talk about, Brian?
We're going to talk about Viking Therapeutics as soon as
Okay.
we get through and the ticker is VKTX. Okay, so here's my binary event valuation. And basically we're looking at a binary event, and we're going to predict the price if it's positive. We're going to predict the price if it's negative, and then we're going to figure out the likelihood of it being positive, and then the likelihood of it being negative is just 1 minus the likelihood of it being positive. So in this very simple example, if the company was supposed to be at, if we think it's going to go to 100 if it's positive, and there's a 50% chance of that, and we expect it to go to 0 if the event is negative, and there's a 50% chance of that, then obviously the current valuation should be 50, right? And then then I've got here the actual current valuation. So that's the expected valuation after this event happens. And then here's the years that it might take for that event to happen, and what the compounded, this is the formulation for the compounding growth rate. So what it would look like if it took 2 years to go from 25 to 50, you've got a 41% compounded average growth rate. And if it takes 5 years, then you're only getting 14.87%. So that's how this very simplistic view of how a valuation might look. So then if we go to Viking Therapeutics, this is what its stock chart looks like. So it's currently at 30.64, and it's traded, up above 75 when people were really excited about the phase 2 data. They're going to run a phase 3 clinical trial that they'll start in the second quarter. It should take at least a year to probably a year and a half, let's call it, to run the clinical trial. So that puts us at the end of 2027. So basically, let's call it, 2 years from now, at the very least, before it's going to read out the clinical trial data. But I think it's reasonable to say it might go to 80 or 90. Certainly that seems possible, probably higher, but let's just stick with 8. Let's stick with 90 to be fair, that, it certainly was trading that high, up here. So it should be able to return to at least 90, and it's at 30.64. So if we just plug that in here, 90 and, I'm sorry, 90. Yeah. And then the current valuation is 30.64. And then what's the likelihood of the phase 3 clinical trial being successful? Well, I think it's pretty high. It's probably, we're not going to say 100%, but let's say it's, 80. I think 80% is probably reasonable given the strong phase 2 clinical trial data. So if we put in 0.8 here, then this one automatically changes to 20% likelihood of success. And so the expected valuation, based on the fact that you only have an 80% chance of going to 90, and I'm being very conservative here and saying it would go to 0 if the clinical trial read out nothing and it was negative, and they have other drugs farther back in development, including an oral version of the drug. Although if the injected drug doesn't produce positive data, then you might think that the oral drug might not either. But let's just be conservative and say it's going to go to 0 if the phase 3 clinical trial fails. So that means the expected valuation is here, and you could expect a return of about 54%. If we're right on all of these numbers, this number is given, then you would expect a 54% return if it could get back to 90. If it's about get back to 90 on a risk adjusted basis, that valuation is actually 72, and then you're expecting a valuation, you're expecting a return of 53%. So the question is it worth taking the risk buying the company right now with the expectation that you might get a 53% return over average over 2 years, which seems like a pretty solid return. Obviously, if the clinical trial takes longer to read out, then you're looking for a 32% return. If it reads out, but my theoretical 90 doesn't hit until the FDA approves it. Now we're looking out, probably out to possibly 4 years from now, and that's a 23% return. So substantially less than the 53% return, but certainly a reasonable return on investment. So that's sort of how you look at binary events where you can't value the company based on anything historic. You have to base it on what you think the future value might be, and then take an educated guess on the likelihood of the event being positive or negative.
So it sounds like you're using this for companies that have nothing on the market yet.
Right. Yeah. So
pre-revenue.
Viking Therapeutics doesn't have any products on the market. So their most advanced drug is going into phase 3 development right now. It's an obesity drug. And then, I don't know, the 90s feels low to me, but I use the 90 as based on the historical valuation. Maybe that was, clearly that was higher than the expectations. I think there was a lot of expectations that it would have got acquired, and so that's the reason why it has dropped so much, is because the company didn't get acquired, and they're going to run the phase 3 clinical trial on their own. And so I think the valuation has dropped from 90 to what was it, $30. It was as high as 90. It traded above 75 for a little while, and I think the reason why it's dropped by 50% is just because investors aren't convinced now that it's likely to get acquired. We've had quite a few different acquisitions or licensing deals by big pharma that have been other companies that haven't been Viking Therapeutics. So every time one of those happens, Viking Therapeutics drops a little bit more because it becomes less likely that there's one less pharma partner that they could potentially take on. So
yeah, what I love about that spreadsheet you just showed us is its simplicity, because I think one of the things that's intimidating for investors as it pertains to valuation is if you talk to people who are very into the predicting future cash flows and doing discounted cash flow models and things like that, it can be kind of complicated. It can be intimidating, and it can make people go like, forget it, I'll never figure out valuation. But something like what you did is just a one line on this spreadsheet, simple math. And I think it's helpful for a specific type of company that is just really hard to value. I remember you and I were on Motley Fool Live years ago, like 2021, 2022. We were talking about Moderna. And this was when they were still raking in money with the COVID vaccine, or maybe it had started to slow down, but it was still doing, they were generating a lot of cash and profits from that. But that was the only thing they had in the market at the time. And I remember you said, like, the hard thing about that company is it's not a pre-revenue company. It has this one product that is currently generating a ton of profits and cash for them, but we know that that's going to slow down, right? We were far enough into the vaccines and the pandemic to know that, we were going to come out of it. It was going to slow down. And I remember we were talking about how hard it was to even get a gauge for how to measure the valuation of that company, because everything else was down the line in the pipeline, and here we are now, a couple of years later, They only have one other than other variations of the COVID vaccine. They have only one other product on the market now, too, still, right? So now they have two, like the COVID vaccine, and I think it's an RSV vaccine, if I remember correctly.
Yeah.
So yeah, these biotechs are difficult to track generally, especially if you don't have a science background, which thankfully you do. But when you look at the valuation, they're all in different places. You know, the pre-revenue ones with no products, the ones that just have one or two products, that's a different ballgame than the established companies that have been around for decades or hundreds of years and have multiple products and tons of profits. So I really like the simplicity of that.
Yeah, and then just to I mean, you have to at some point get a guess in for that price. So one way, I did it historically based on where Viking Therapeutics had been in the past. But another way to do it is to look at a company that only has, that has a similar product, with a similar size of its market that has, recently gotten an approval, and then use that market cap as a potential market cap, and then translate that market cap into a potential share price by dividing by the number of outstanding shares right now, and then that you can use that number as your price if the event is positive. So and then probably the hardest one, actually, that one's actually, I mean, I think that one's fairly easy to figure out, and you can be conservative if you're worried about figuring out that number. I think the number that's really hard to figure out is the likelihood of an event being positive, right? That's clinical trial readouts are not exactly super easy to figure out. I think it depends on certainly phase 2 clinical trial readouts are very hard. Phase 3 are a little bit easier because you've got a substantial amount of data from phase 2. And if the clinical trial is reading, is enrolling the same number of patient, the same type of patient in the phase 3 clinical trial as they are in the phase 2 clinical trial, then it becomes a little bit easier, and you can, guess that it's going to be in the 70 to 80% range are going to be positive for the phase 3 readout, if the phase 2 readout was very clean and clear.
Yeah, but I agree with that. I think what's nice about that method that you have with that spreadsheet is you can run different models, right? You can run what does it look like if there's a 90% chance? What does it look like if there's a 70, if there's a 60, if there's a 30, right? You can really, and then you can kind of make your best guess as to how optimistic you want to be about the potential of that particular trial. But I think, I just to take a step back and talk about valuation generally, I think it's important to know that, or for people to think through the idea that it's not an exact answer ever, right? If it were as easy as building any kind of spreadsheet to know exactly where a stock is going to be in the future, we'd all be super rich. There'd be computers doing that for us, and there'd be no point in investing in stocks. So I think the value,
there'd be no change in the stock price, until there was a new earnings release, right? Because
that's right.
It would just be the same, whatever price was based on the known future, right? So,
but I think the idea is to be directionally correct, or at least as directionally correct as you can be, and that's what I like about anyone who does use spreadsheets of any level of complexity. I like the fact that you can run different models, right? You can say, like, here's my optimistic price or valuation that I'd be willing to pay. Here's my middle of the road one, and here's my super conservative one, right? And then you can make your decisions, your buys accordingly. Maybe you spread your bets out if you're not as confident, or you put a little bit more in it all at once if you are more confident. So that was really cool. I'm glad you shared that with us. All right, we got some questions that came in during that. I'll grab one to kick things off. Brian, you can find one that you want to grab. So John Gallegos, good afternoon, gentlemen. Hey, Jeff, how do you value Outset Medical? He's busting my chops a little bit, Brian. He knows that that's one of the ones I've taken a big bath on. And then he says, in all seriousness, can you give your thought process in valuing Costco and adding to it? So I'll talk about Outset really quickly to say that for me, in my portfolio, that stock is down 96%, something like that. I don't really look at it much anymore. I'm leaving it there as a learning for me. And so I don't value that one currently. Costco is an interesting one because, and I've said this a few times on Fool24, Brian, but I had been watching Costco on my watch list for years. And I finally, about the middle of February, decided I was just going to start a tracking position, a couple shares just to kind of get it in my portfolio, get me to pay more attention to it. And I started the bear market. So if you were looking for discounted prices, y'all can thank me. But if you're upset, I'm sorry. But I bought it and it almost immediately started to come down, which is exactly some point. And it's relevant to the conversation about valuation, because by all of the metrics I talked about at the top of the hour, looking backwards at price to earnings, price to free cash flow, looking at averages and medians in the past and thinking through what I think the future might look like, I made the argument several times to myself that it was absurdly overvalued. And actually, to your earlier point about what was it doing growth-wise when it was highly valued versus when it wasn't, the answer is it was doing the same thing, in my opinion. Like, it wasn't any more successful in its financial metrics over the past 6 months as it approached 60 times earnings than it was a year or two ago when it was around 35% earnings. Like, it's a big established company. It grows steadily, but I don't see an event where it goes from single digit growth to high double, 30% growth or anything like that. Like, I don't see it growing into this valuation over time. So that was the situation where I bought a stock knowing I felt it was overvalued, because I just figured over time, as I learned more about it, got more comfortable, thought about its growth more carefully, I would find better opportunities to add to that position. It's one that I think I can dollar cost average in over time. So that's how I think of the valuation for Costco for me, John. It's really just about making sure that business continues to do what I think it can do, all the metrics I follow, all the key performance indicators that I'm looking at, and finding better value points along the way to just build out my position over time. Because I'm a dollar cost averager into most stocks anyway. But if I don't have it in my portfolio, I'll miss an opportunity, right? Because I won't look at it regularly. And then I look back and go, oh, 3 months ago, it was trading for this valuation and I should have picked up some shares there. So that's how I look at that one. All right, John, is there one you want to grab, Brian?
Rose asks about Vive. It's a Viva
Systems.
Viva Systems. So this is a picks and shovels for the biotech industry. Let me get I'll share my screen so we can look at the chart and see how the different things are looking. So Viva Systems is they sell different products, mostly software-based products. I think maybe all software-based products to the biotech industry, and they've tried to expand into other industries, but primarily into biotech and pharmaceutical companies is where their main customer is. And so they're selling everything from how to track your clinical trial data to they started off with a CRM for sales managed for product sales. So drug companies have sales reps that go to doctors' offices and try to get them to prescribe more of their drug, and so and talk to them about the benefits of the drug. And so this is a customer relations management tool that was specific to doctors, and so that drug companies could use drug companies with products already on the market could use the products to continue to sell them, and would give them information about the doctors and how bring in information from other sources on how many prescriptions that doctor was writing for their drug and for competitors' drugs and that sort of thing. And then they've expanded, so lots of data stuff now that they've got the CRM down. A lot of onboard, cloud-based data storage for the biotech industry is what they're more into now. So you can see they were the valuations. So the brown is price to free cash flow. This one is price to sales, and the light. Let's see. The purple is the price, so we can just get rid of the price because we don't really need that for the valuation. And then so this one is the price to the PE ratio, and then the orange one is the revenue year-over-year growth rate, right? And then this blue one is the forward PE that's based on analysts figuring out what they think the earnings are going to be for the next year, and then looking forward. So you can see the valuation, all the valuation metrics have all come down since then, and that makes sense because the revenue growth has come down, right? They're still growing at 14%, and they were, up in the 22% range one quarter in 2024. But generally, they're sort of trading in this band here, and that's the same band that the valuation has been trading. We don't have very much change here. If we go, let's go to 3 years so we can get that off of our plate. So you can see if we start in 2023, the valuation is pretty, the valuations metrics are pretty consistent all the way across the board. I mean, obviously they're going up and down, but they're trading in this band here, and the valuation the revenue has been sort of all you look sort of all over the place, but the difference is not. I mean, there's one low quarter and one high quarter here, but if you ignore those two, they're basically trading, and it's been growing in this band of, let's call it 11% to 15%, 16% over the last 2 years. And so assuming it's going to continue to grow at that level, then the valuation right now looks pretty reasonable, and the potential stock price change is going to be based on this growth rate of revenue, assuming revenue and earnings end up growing at approximately the same rate. If they can grow earnings faster than revenue, then the stock price may even grow even faster, even if the price to sales ratio and price to earnings ratio and price to free cash flow ratio stay the same, right? Because if the earnings if the earnings are going up, then and the PE stays the same, then the price has to also go up by the exact same percentage, right? So I think that's the way I would be thinking about Vive, is that it looks like it's fairly valued right now, and it just depends on what your expectations for the growth rate are, and if it can stay in this band of 11 to 16, 17% growth, then I think it's a reasonable valuation. I've never owned this company, mostly because I've never been able to figure out what they're going to do next, but they've always proven me wrong that there was some other product. I mean, I think they do a really good job at listening to their customers, figuring out what their customers want and need, and then going out and building that product and then selling it to them. So I've been impressed with the company, just have never been a shareholder because I've never known what is next. And they always seem to have come up with something new over the last 10 years. They've probably launched 4 or 5 products, and they've all been quite successful.
Yeah, it's one that I've not bought either, but I've always been sort of intrigued by it. I like picks and shovels plays, especially in industries where there's a lot of risk, or I'm not comfortable, or I feel like there's a lot of outside my circle of competence, which I would certainly put biotech investing outside my circle of competence. I have a few stocks that I've invested in over time with mixed results. If I were to get heavily into this industry, I would probably want to do it via ETFs or maybe some of these picks and shovels plays to not have to put my eggs in any one biotech company's basket, so to speak. All right. There's a lot of biotech stuff that you can choose from here. I'm going to grab one that's not biotech. About 25 minutes ago, we got a question. How would you evaluate Stitch Fix, ticker symbol SFIX, today going forward for 5 years? So Stitch Fix is a stock I also used to own. I was very excited to buy this years ago because at the time, so many people in my life were using the product. And I used it too, and I still do every once in a while, because I love the idea of not having to worry about buying my own clothes, Brian. That is, I would pay any amount of money to not have to worry about that. I guess I would evaluate it a couple of ways. I'll answer it for business wise, and then I'll talk about the valuation piece of it too. Business wise, the reason I ended up selling is because as I thought about it, I think what I wasn't realizing when I bought the shares was I don't know how big the market is for this company. Coming out of the pandemic, I believed convinced myself, I made myself believe that they would have some tailwinds as people were, maybe returning back to work, going into the office, needing to buy clothes because they've been sitting on Zoom in sweatpants for a year and a half. And I think that was probably true. I just vastly underestimated how many people were going to do something like be a Stitch Fix subscriber to do that. And they changed their business model a little bit along the way. First it was entirely sending you clothes to try on and send back the ones you didn't want. Then they were trying to get you to buy stuff in the app straight up. Then it landed on some sort of hybrid of those two business models. I don't think they really knew what they wanted to be. So my big concern, like I said, is just I could see the reason to buy shares again. Some things have started to look a little bit better over the last several quarters. I still can't bring myself to believe that there's enough people who aren't currently customers that are going to be. I think this is just a niche product for a niche amount of people that I don't know if it'll ever be able to really generate market beating returns. That said, valuation wise, I'll try to do a screen share here if I can figure out how to do it while I talk. Here we go. So valuation wise, whenever the screen pops up, we can see it, but I'll start talking through it now. I just pulled up price to sales. You can't pull up price to earnings for this stock because it's not consistently profitable. But it trades for 0.371 price to sales. And, with no other context, that sounds cheap, but you have to remember price to sales, especially, but all these metrics really do depend on the industry you're talking about. This is not a software as a service company. So you're going to see a lower price to sales than you might see for a software company. It's near the lowest it's ever been. So from that standpoint, you could say, okay, maybe it's worth taking a look at. If I look at price to free cash flow, that's trading about 33. That's been a lot choppier over time, but I would say it's looking like that's near the low end of where it's been in the past, excluding the huge ups we saw early, during the pandemic and things like that. So I guess you could make the argument that it's inexpensive based on its historical averages and things like that. But again, to me, the valuation piece is secondary to what I think the business's potential is. Because something can be cheap by any metric. Like you could have 1,000 people and ask them and they all say, yes, it's cheap. But if there's not a viable growth market ahead, that may not matter. And now look, it's certainly more attractive as a stock now than it was when it was overvalued during the pandemic, when it was on everyone's radar and it was trading for, 250 times free cash flow at one point. But to me, that's how I evaluate it. I don't see how it has a big enough market to grow into to justify what is now historically a cheap valuation.
Okay, so Playum asks, how do you feel about Harmony Biosciences, tickers HRMY, short-term and long-term? Thank you. Okay, so this is a company that I know almost nothing about, but I think this it's a good way to like what would I do if I, somebody told me that this was a great company and what should we, you should go buy it. I'm not going to base my opinion on their specific, thought process. I'm going to go look at it for myself. So the first place I'd start is what products do they have on the market? So I'd go over to or what do they have as in their pipeline, and do they have products on the market? So they do have a product on the market. Here it is. It's Wakix. It's a treatment for narcolepsy, and it's actually doing quite well. 714.7 million in revenue in the for the full year of for the full year of 2024, and they're expecting 820 to 860 million in revenue with a potential $1 billion opportunity. So they're they're looking for growth of that's more than 10%. That's about 15, maybe a little less than 15% growth year over year, depending on where maybe more if they hit the top end of growth. And so substantial growth still, and then potential over $1 billion in sales. So potential growth there. And then if we go to the pipeline, they've got a phase 3. This is the same drug that's approved for narcolepsy. They're testing it in a whole bunch of other neuro diseases, and they've got a phase 3 clinical trial running for this Prader-Willi syndrome, which is a genetic neurological disease. I wouldn't give any value to the things that are in phase 1 clinical trials, because it's so early that you don't have enough data to be able to ascribe any value, and it's so far away that the time value of the potential of the drug is such that there's no reason to add onto it. So we'll just ignore these. Then they've got this cannabidiol gel for Fragile X and another genetic condition that's one's in phase 3 and one's presumably moving into phase 3, because it looks like it's beyond this phase 2 here. So it's probably already read out the phase 2 and they're moving it into phase 3, but the clinical trial hasn't started yet, would be my guess there. Then they've got for rare epilepsy, these 2 genetic conditions that cause you to have seizures, and those are in phase 3 development. So this is probably, potential to, between these 3, certainly to double their sales, up to $2 billion. So I think that's, right now they're at 800, let's call them 850 million in sales. And then, their potential to get up to 2 billion in sales. I think that if they could continue, so the question here that I haven't been able to figure out in the 3 minutes that I was looking at it while Jeff was talking, is when does the patent on this run out? And I'm going to guess it might be close, because looking at this valuation of the company, it looks pretty cheap it's trading at 2.6 times revenue, right? So that tells you that and it's still growing at 15% clip. That I think if drug is growing at a 15% clip, and it should have a price to sales ratio at closer to 4 or 5 would be my way of thinking of being fairly valued. So I think this is either way undervalued, or these revenues are going to go away sooner than in the not too distant future, and so investors have already discounted the valuation based on the fact that this valuation is going to go away. So that would be the next thing that when I was looking at a company like this, and we're not going to do that because it would take a while to dig through SEC documents, and that doesn't make for good television. But that's the way I would be thinking about valuing this company. Is it looks cheap right now, and anytime I see a looks cheap, I will not invest in the company until I can figure out what the bear case is. Now, I may discount the bear case and I may still invest in the company, but I refuse to invest in a company if I can't understand why people are selling at the current valuation, because there's got to be some reason that people are own shares and are selling them at this stock price, because that's the stock price is defined by somebody buying and somebody selling at the same price. And so I think you always have to know what the bear case is, and I would want to figure that out before I moved further and tried to invest in this company. But on the surface, it looks like a good growth, and certainly 2020, basing it on potential sales in 2025 and a nice pipeline. I think that it looks like a nicely valued company. It's just there's got to be some reason that it's trading at 2.6 times sales.
Yeah. And I think that's, that I like that we keep coming back to a business first way of looking at valuation, because, you can run a screener, you can just search for stocks that are trading for very low valuations. But then, like you just said, the question is why, right? Like either the market's missing something potential wise, or it's cheap for a reason, right? Or it's somewhere in between, like it's along that spectrum. And I think I love that idea of, I don't buy anything until I figure out the bear case. Like what's I've also heard other people call that, like, to do a pre-mortem on the company, right? If this investment goes wrong, what happened?
Right.
Like what went wrong? Why did this not work out for me? And kind of put that out there as a way to kind of predict what might go wrong before you buy shares. All right, I'm going to take one from about 46 minutes ago from Besties. What is your view of Kinsale, KNSL, for the next 5 years. So this is a stock I own. I'm a huge fan. High conviction holding for me. Kinsale Capital, it's an insurance company, an insurer, but they specialize in what's called E&S insurance, which stands for excess and surplus. So that is the best way I can describe that is all the weird stuff, right? So think hang gliding businesses and skydive businesses and axe throwing businesses and go-kart places, like all the hard to insure because there's not a lot of them, there's probably not a lot of data out there, like that's what they specialize in. And that you have to be very good at underwriting insurance if you're going to be insuring that part of the market, because it's not like insuring homes and automobiles where there's hundreds of years of data on what's risk. If someone opens a new business that there's not a lot of around, you have to figure out how to insure that profitably, and Kinsale has a long history of doing that. Now, talking about valuation, this is another one that is historically expensive, and for good reason. They've put up very solid results for a long period of time. They are a very good operator in their market. Right now, it's trading for about 25 times trailing earnings. That has been as high as 80-ish back in like late 2020, early 2021. It's been as low as below 25 back in 2017, just to give you some range here. This is one where I think I mentioned this earlier, but one of the things I like to do is, in addition to looking at the historical valuation, but just think forward, what might this do in the future? And they only have, I believe the number is 2% market share or something like that in the E&S part of the insurance market. And yet they've been a solid operator for a really long time. And I think part of the reason that their market share is smaller is they don't chase growth, right? They're not insuring every business they come across just to get more business. They are careful where they insure so that they're doing it profitably and conservatively and smartly. So to me, the premium valuation that this typically trades for, or at least has until kind of recently, makes sense, because I feel like they have a track record and the market opportunity in front of them is substantial. Now it is trading for 25 times earnings. Like I said, now that's near the market multiple. Like that's not a crazy price to pay right now, but in 2023, it was up over 50. So this is another one where I've owned it for, I don't know, 3 or 4 years. And I've bought it at all different price points and valuations over time. I could see myself adding to it again at today's valuation at some point. And that's to my earlier point about the way I think about Costco. I try to own quality businesses. I try to learn a lot about them, and I try to add to them when the valuation presents an hour at a better price. Or I should say at a better valuation, because sometimes you're actually buying at a higher price, but a lower valuation over time. And that's how I build out my positions. But for Kinsale specifically, I don't see any reason they shouldn't continue to be a market beating stock in the future. Every quarter when their results come out, I look at the loss ratio and the overall ratio, the combined ratio, and things are looking good and they're generating cash and staying profitable. And like I said, having such a small part of the market share tells me there's a lot of space ahead of them to grow. So big fan of this company, cheaper now than it usually is. And even when it's expensive, I think it's worth looking at.
So Rita asks, I understand that TransDigm is a set and forget stock. I looked up TransDigm. I can't find the company. I think there may be a missed typo in there because it doesn't seem like that's a company that exists, at least not according to Google. There's a TransDigm, which may be what
I think that's what it is. Yeah, TransDigm Group. Yep.
Yeah. So I don't follow
TDG is the ticker.
Yeah, I don't follow TransDigm. I don't know if you do. But I think that the last part of her question is interesting, regardless of whether you follow it or not. But she asks, are there other set and forget stocks that you would recommend? And so, I think I think there are probably, large pharmaceutical companies that you could buy and just not worry about. I think Johnson and Johnson is one. I once wrote an article where I just looked at, I took a chart, just a price chart of Johnson and Johnson, and I just looked at I picked out the highs and the lows, over the time, when it would dip and come back up, and I just bought theoretical buying of shares at each one of those prices. And of course, the lows, not surprisingly, beat the S&P 500. But when I did this experiment, all the highs also beat the S&P 500 if you bought the S&P 500 at that point too. So I think there are companies like this where I would feel comfortable buying and just not looking at it for the rest of my life. I think, I don't know, maybe Pfizer would be another one where I would feel comfortable buying at sort of any price and not worrying about the valuation that much. And certainly Johnson and Johnson, maybe this was before they spun off their consumer healthcare business. So I think it was probably a little bit more stable then. It's going to be a little bit more volatile now because when they have drugs that go off patent, there'll be a larger percentage of the total revenue because the total revenue has fallen because they don't have those consumer healthcare products. But that was a slow growing business. So in theory, it could, it'd be more volatile, but you'd have higher revenue. You'd have higher revenue growth, and therefore higher share price growth. In theory, Jose and I got almost a similar question, which last night, which was if you were forced to not look at your portfolio for 10 years, what would you do differently? How would you change it right now so that before the freeze came in 2 days, and you couldn't change it for 10 years? So any thoughts?
I love that question. To answer this one specifically, well, first of all, I just want to say, I think the question might have gotten asked while I was on, because I've talked about TransDigm with Lou Whiteman a lot. We've been doing a lot of shows together, and that's one that he's super excited about. It's a aerospace parts maker, right? So like you need this really specific part for your engine. You're going to go to TransDigm to get it. So it's a picks and shovels play on the aerospace industry. But and Lou had said he thinks it's as close to a set and forget stock in that industry as you can get. So the cop-out answer for me is Berkshire Hathaway. And I only mention it because even though it's like I probably one of the most stereotypical set and forget stocks you can mention, I only mention it because I actually did set and forget it literally almost 2 years ago. I went to the Berkshire annual meeting in 2023, and so I bought some shares so I would be a shareholder and I could go. And then I never paid attention to it again. I literally just bought it for that purpose. So I wasn't really following the results other than to talk and write about them for the Fool. And here I just opened my spreadsheet, and those shares I bought a couple years ago just to go to the meeting are up 65% and crushing the market. So that is one that I have seen work as a set and forget stock, because I actually did set and forget it. I'll throw another one out there that's in an industry we haven't talked about much at all today. But ASML, ticker symbol ASML, makes the lithography machines that you have to make semiconductors. And it will fluctuate. It will do well. It will struggle. It's a cyclical industry. There are risks for any investment. But in that space, which I think is one of the most likely to be super important 20 years from now as it is now, the semiconductor space, in that space, this company is indispensable. And when it comes to the highest, most cutting edge chips, they are the only company in the world that makes the machines that can make those chips. So to me, that's another one where you can just set and forget that one. And there will be periods of time where it underperforms, but I think over the very long term, that's a winner. So that's one that I would throw in there. If I couldn't touch my portfolio for 10 years, I'd have to really think about this one. I had a conversation about this one the other time. And the thing I struggled with is, do you go safe or do you swing for the fences? Because you're not going to it's a 10-year hold, right? So like, do you mix it up with some safe things and with some swing for the fences things? I think I'd probably put things in there like ASML and Costco and Berkshire Hathaway, but I don't know. I'd also be tempted to pick up some small caps that I think have high potential and just see what happens in a decade. But I'd have to give that one more thought to give a better answer. All right, we got about 5 minutes left. Looking through, is there another one you want to grab? If not, I'll see what I can hit on here.
I can grab this one right here.
Sure.
David points out there's a white paper that estimates that the total addressable market of liquid biopsies is at $60 billion. That would include companies like Roche and Illumina and Thermo Fisher and Guardant Health and QIAGEN and Biocept are all big players. Any thoughts? I mean, I think $60 billion seems, I don't know, it seems okay if you look out far enough in the future. So these liquid biopsies are tests that are just blood tests. And what they're doing is they're looking for DNA in the blood that's abnormal. And that's most likely coming from a tumor that has sloughed off some of the cells. And then the cells have died. And then but the DNA lasts longer than the cells do. I mean, the cells can be dead, but the DNA molecules can still be around in the bloodstream. And so then they can go from there. They can do the test, see whether you have this DNA, and then your doctor would order, maybe a CT scan or something to try to find the tumor, because a lot of these you may be able to tell what tumor it's from, but a lot of them will be tumors from unknown origins, and they have to go find the tumor, which can be challenging in and of itself. The question is like, which one of these is going to win? And I don't think we're there yet to know which one of these is going to win. And so it becomes really hard to value this $60 billion, even though let's say it's only $20 billion. There's still, it's probably not going to be a winner take all, but there's going to be a winner. There's going to be a company that has the best test that catches the most diseases. And there's going to be ones where they don't detect enough of the cancers that, where you don't have any symptoms. But I think it's reasonable if the test is good enough that everybody's going to be getting it. If everybody's getting it, I think 20 billion is probably more, 10 to 20 billion is probably more reasonable for a market size for a test that almost everybody's going to be getting at their annual physical. But, I think that that's going to be split up amongst multiple players, and it's probably going to be, one company is probably going to take 80% of that, and then the other 20%, could go to the other ones. Now, of course, if they're all sort of equal, then it becomes this game where they have to, play with the insurance companies and try to become the exclusive provider of the test for this insurance company. And then maybe they have to give price breaks to the insurance company to become the exclusive test if they're all sort of about the same level of accuracy. So I think that becomes challenging to know the future of this industry, because especially if there's one winner, you don't know what the winner is. And if there are multiple winners, then they could all end up, cannibalizing each other in terms of price and pushing the price down and then therefore the total addressable market becomes a lot smaller than this, at least this white paper is estimating.
Yeah, no, that makes sense. All right. Well, I can do one more here in the last minute. I think it's a quick answer. Rose asked, how much does valuation matter when choosing an ETF like VHT, which is the Vanguard Health Index ETF? Is it secondary to the companies that comprise the ETF? So one thing you can do is you can look at the net asset value of the ETF and just see what the stock price is compared to that. They typically trade close to one another. I think it's much more important to think about the industry that ETF is in as a whole. If you have a feeling that an industry is overvalued generally, then I think you could make the assumption that from a future returns standpoint, that ETF might also not have the best returns. Like, for example, let's say you think semiconductors are overvalued right now because we're all talking about AI. If you think that, and then you go buy a semiconductor ETF, there's a chance that it will not do as well as you want it to because you think that industry is overvalued, if that makes sense. But the traditional valuation metrics we've been talking about don't really work for ETFs. I think the second part of the question, looking at the companies that comprise the ETFs. I think that's another way to do it. So if you look at VHT, you can click around on the internet and get the Vanguard website. You can see, their top holdings are Eli Lilly, United Health Group, AbbVie, Johnson & Johnson, Merck. And then you can look at those companies yourself and think whether you think they're overvalued or undervalued, and you can look at it that way. But yeah, different ballpark when you're talking ETFs.
Yeah.
So, all right, we're at 4 o'clock. So in a minute, we will have, I believe, Jason and Toby back. They hand it off to us for this hour. We're going to hand off back to them in the next hour.
And then I'll be back after they do their hour. And I'll be on for 2 more hours. So we're just flip flopping.
A lot of Brian tonight. A lot of Brian. I'm out. This is it. I did my 1 hour. I'm going to go enjoy my Friday now. As soon as we get these guys on. But it was good talking valuation with you, Brian. I love listening to how other people think about this because I have my way of looking at it. I talk to different people. They have different views of it. And I don't know that there's a right or wrong way. I think every individual investor needs to come up with their own way of being comfortable with it and thinking about it, making decisions. So always good to learn. And I love that spreadsheet you shared at the beginning. That was good. So, all right.
The YouTube feed was going off the air, but if you're on the Motley Fool website, you'll be continuing till 8 o'clock this evening.
All right.
East Coast time.